Good morning, everyone. I'm Brad Smith alongside Rochelle Akufo. This is Yahoo Finance Live. Let's get right to the three things that you need to know to start off your morning. First thing you need to know, the nation certainly feeling some fallout after former President Donald Trump's indictment. It's the first time that any U.S. president, former or current, has faced criminal charges. Trump was under investigation for his alleged role in hush money payments made to adult film star prior to the 2016 election. Now, the milestone adds another potential complication to the U.S. economic outlook, as an already divided Congress could become more so, making it more difficult for Republicans and Democrats to find much-needed middle ground on raising the debt ceiling. This situation also poses unknowns ahead of the 2024 election, and as the old adage goes, the markets don't like uncertainty.
Indeed.
Second thing you need to know, the Fed's preferred inflation metric out this morning. It rose less than expected. The core PCE for February rising 0.3% for the month, slightly lower than the estimated 0.4%, providing some hope that the Fed's efforts to tighten policy is having an effect. But the cool down hasn't been significant enough for the Fed to claim a win. So they still want to see core PCE cut by more than half to hit their preferred 2% annual target. This as the markets end the quarter on a positive note. The S&P 500 reclaiming the losses from SVB's fallout as investors feel more optimistic on the outlook for the banking sector. And big rallies in tech stocks like Apple and Microsoft saw the Nasdaq 100 surge to a bull market for the first time in nearly 3 years. And the third thing you need to know, Bitcoin's big rally made it outpace actually the broad equity market gains here. Bitcoin rose by more than 60% here, and the cryptocurrency's latest leg higher likely driven by a distrust in the banking system prompted by the collapse of SVB. But there may be trouble ahead for the notoriously volatile cryptocurrency market. Crypto exchange Binance was sued by the Commodity Futures Trading Commission, and that who accused the company of skirting regulatory requirements. The CFTC is one of several watchdog agencies investigating Binance's activity in the U.S. here. And so those are your three things this morning.
That's right, Brad. Now, former President Trump's indictment could spell chaos in Congress and set up a wild ride for the 2024 presidential contest. Joining us now to break down the latest is Yahoo Finance's own Rick Newman. Hey, Rick.
Hey, guys. Quite a political earthquake here. One thing I would like to point out is there's an assumption that these charges, which we don't know yet, mainly relate to, the hush money payment to Stormy Daniels. And that probably is a part of it. It could be a big part of it. But there are also reports that there could be up to 30 separate charges in this indictment, and that some of those involve business fraud allegations, tax fraud allegations, things like that. So it is possible that this indictment by the Manhattan District Attorney of Donald Trump is much broader than we have been led to believe by the leaks so far. We have not seen the indictment yet. It's not public. We may not know what is in there until next week, when Trump is reportedly going to show up at the Manhattan DA's office for an arraignment. But this could be broader than we have been led to believe. So I think that's something everybody should keep in mind here.
And Rick, what have we heard from Florida on this? Of course, Mar-a-Lago is where Trump has been spending all of his time. So there's really going to need to be some cooperation there, if any.
Well, it sounds as if Trump is going to voluntarily show up. Trump, of course, says he's innocent of all charges. And I think what we can expect is that Trump is going to do everything he can to play this to his advantage and make it look like he's the victim of a, quote, witch hunt, which has been his go-to phrase now for what seems like decades. So there's now this political guessing about, does this actually enhance Trump's popularity within the Republican Party? Does it give him an edge in the Republican primary election for 2024? I don't know about that. I do think that it would damage him in a general election. Polls show that a majority of voters of all parties think Trump should actually be disqualified from running for president if he is charged with a crime, which apparently he now has been. So I think what this does is throws the Republican Party into more disarray than it has been in, if that's possible.
All right. Yahoo Finance's own Rick Newman teeing up the conversation for us. Trump's indictment marks the first time a president has faced criminal charges. Joining us now is Nick Ackerman, who is the former Assistant U.S. Attorney General for the Southern District of New York. Now, thank you so much for joining us here today. Just to kind of put more context around this and where the proceedings go on for here, what is the next step to the entirety of this, as our own Rick Newman was starting to lay out there?
Well, the next step is actually the arraignment, where Donald Trump has to go down to the courthouse. It looks like it's going to be Tuesday. He'll be booked, which means he'll be fingerprinted, photographed, and then taken before a judge. He will either have the indictment read at that time, or he can waive the reading of the indictment, and then he will be asked to plead guilty or not guilty. Very rarely do defendants go in and plead guilty. So he'll plead not guilty. Bail will be set. I think in this case, he's going to be released on his own recognizance. And then it goes from there into discovery. The DA will be providing its evidence and documents to Trump's lawyers. And there will be all of these pretrial motions that will ultimately lead up to a jury trial on the charges, which we do not know what they are at this point. But that is, in a broad brush, what's going to happen.
Indeed. The indictment's still sealed at the moment. We don't have the specifics of the charges, but based on some of the investigations and what we know that the lawmakers have been looking into here, what are the most likely charges that perhaps have the most strength here?
Well, I think the one charge we all know about are the hush money payments relating to Stormy Daniels. And the whole scheme involving Karen McDougal and the idea of catching and kill any bad publicity that might come out before the 2016 election. However, we also know that the state's attorney general's office brought civil complaint against Donald Trump for falsifying his financial statements every year, for bank fraud, for insurance fraud, for all kinds of other tax fraud. And the question is whether any of those items will wind up being charged in this indictment. We do know that Donald Trump asserted his Fifth Amendment privilege some 450 times in response to questions asked of him in a deposition in this case, which means that he basically would not testify because a truthful answer would tend to incriminate him. The question as to those 450 potential crimes is whether or not there's enough evidence of Donald Trump's intent and knowledge to put those into a criminal indictment such that they can be joined with other counts relating to the hush money payments, all of which go to the central theme of falsifying records in the Trump organization.
And so what this comes down to in the proceedings going forward from here as well is whether Trump would actually face any jail time for the criminal charges that have been levied. Is that even likely here?
Well, he has to be convicted, obviously. Right. I think the case, at least as far as what we know publicly, is a pretty good case. And then the question goes to sentencing. That's a whole other process. And I think it just all depends on the charges and what the evidence is that comes out during the trial. But there's no reason why he wouldn't be treated any differently than any other defendant in the same circumstances, which could ultimately mean jail time.
And Nick, we are in unprecedented territory, and you say perhaps we wouldn't be if Nixon had been held accountable for his crimes. But I mean, what people are wondering in terms of how this could affect. I mean, obviously Trump can still run for president. I believe even if convicted or indicted, he can still run. But constitutionally, what does that mean for his campaigning?
Well, first of all, the only qualifications to be president of the United States are set forth in the Constitution. You have to be 35 years old, and you have to be born in the United States. Other than that, there are no other qualifications spelled out there. However, I just don't see how this indictment, and there's going to be we know there's going to be a Georgia indictment probably before the end of April. There's also a good chance of indictments on his obstruction of the classified document information, as well as the January 6th investigation. There's no way that the Republican Party, that is the representatives and the senators and governors running for re-election in 2024, are going to want to have the head of their party be under indictment in various jurisdictions. It just doesn't do anything to increase their base or increase their vote. Politics is about bringing more people in, making a bigger tent, trying to mobilize other voters. This is just going to turn off a lot of voters in various states and suburban women, et cetera. I mean, this is not a resume builder for somebody who's planning to run for president.
Well, you could say that about many other steps along the way in terms of the timeline of either Trump's administration, even his running up to becoming president from 2016 to 2020, and even thereafter in his attempt to run for re-election. And so all that considered, there's been nothing to stop the party from endorsing him before. But what's different about this time is the fact that you have a midterm election, a previous general election, and even runoffs that have gone the other direction against some of the candidates that he's backed in the past as well.
Well, that's correct. And what people don't realize is that once you're under indictment, and then to be under indictment multiple times, you've got to spend a great deal of your time working with your lawyers. You have to appear in court for various hearings. This is going to take up a huge amount of time. And if you're running for office and you're a Republican, the last thing you want to have happen is every time you show up for a town meeting or for a campaign event, the first question is going to be, how can you run on a ticket with somebody who's been charged with multiple crimes? In addition, you have this other bombshell that's waiting to explode the end of April, which is a civil case against Donald Trump, essentially for rape. And the judge thus far has made rulings which has made this a pretty compelling and almost overwhelming case in which Donald Trump will have no choice but to take the witness stand in his defense. And there are going to be three women essentially testifying that one who's going to say she's raped and the others who are going to say that they were sexually assaulted. And there could be a finding in May that Donald Trump is a rapist. Again, not a good look for somebody running for president.
Yeah, I mean, well, of course, there was the settled out of court lawsuit for his discriminatory actions, even as a owner of residential properties in New York, too. So all of those things considered, within this case specifically of business fraud, what does that mean related to the other businesses that he is entangled with or runs in some facet or the other? Largely, a lot of people might be looking at ticker symbol DWAC today, given the Digital World Acquisition Corp's annexation to Truth Social, which is a Trump social media property.
Well, look, it's going to have an impact on all of these companies that Trump controls, because what banks are going to want to loan money to these companies? I mean, that's the big problem. This particular count, or whatever counts there are in false business documents, is pretty much standard fare for the district attorney's office. This is a crime that they bring pretty regularly. And it's going to have a wide-ranging impact on the company's ability to do business. Don't forget, the company itself has already been convicted in state court in New York of criminal violations. So it's not inconceivable that now that you're bringing in individuals from the company, that Donald Trump won't be convicted. You've got the chief financial officer serving time now at Rikers Island, Michael Cohen, who is going to be one of the key witnesses in this case, has already served a year in prison. So it's not a good look for Donald Trump or for his corporation.
We'll certainly be keeping a close eye on that. We do appreciate you joining us with your insights. Nick Ackerman there, former Assistant U.S. Attorney for the Southern District of New York. Thank you so much.
Thank you.
Well, an action-packed first quarter coming to a close as stocks eye a second straight quarterly gain despite banking stress and elevated interest rates. Let's take a closer look at some of the best and worst performers, starting with the S&P 500. So as we're looking here, we've got Nvidia, Meta, Tesla, Warner Brothers Discovery. I thought NVIDIA was an interesting one. A lot of people looking at it as a real strong AI play, especially. We saw from Stacey Rasgon at Bernstein, he reiterated his outperform rating, raised his price target forecast to $300 from $265. And this really is based on this need, this expected need for these NVIDIA chips to train the AI models that are going to be running this generative AI that's clearly in demand at the moment. And we saw that NVIDIA CEO Jensen Huang announced a wide-ranging set of partnerships for the products as well. So this really does seem like a long-term play that NVIDIA is really capitalizing on.
Yeah, and a few things within the best performers. I mean, you also look at the environment that they're wading through right now, whether that's on still the fundamentals, not really having clear sight going ahead. You don't know when the digital advertising market is going to resume the type of spending that we had seen in 2021 or even 2020 as everybody was spending more time on their devices and everybody wanted to get some of their attention and get some of the dollars that consumers were still willing to spend to whatever extent. So there's the digital advertising market, and even with that, there is still a buoy that companies like Facebook and Google could benefit from because they're typically seen as the two behemoths, the duopoly that's been able to drive that narrative for so long. However, that is getting a little bit more different because of the type of devices that end users have in their hands on a daily basis. You know, all that considered though, on how we go forward from here, semiconductors, even the rebound there, you could really kind of sum it up in some of the worst performers of last year being some of the early year best performers here in 2023. And if you look at some of the worst performers as of right now, it's the names that should have what is the adage? Beware the Ides of March, right? Banking sector probably could have benefited from that because of the turmoil that we've seen take place there. Some of the biggest decliners there, you're seeing regional banks. First Republic, of course, the most outsized there, and that has been down by about 89%. But much of that move significantly coming, of course, during March, given the fallout and given some of the different stressors that have impacted and the missteps that management has made within some of the regional banks there that have resulted in the injections of cash and capital that they've needed to take on just to stay or try to stay afloat right now too.
It's true. I mean, and speaking of some of these worst performers in the S&P, you also have in there Dish Network, one of the few pure streaming plays still left in there, really trying to find its place in this market. You have Amazon, Apple, all the others sort of getting into this space. Dish Network still searching for some direction there. And even as we look at some of the best performers in the Nasdaq 100, NVIDIA again making another appearance, but also Meta, Tesla, you have CGen as well. A lot of people wondering, you know, what's going to be happening with Tesla. You know, a lot of headlines, so obviously surrounding Elon Musk, but we saw what their production targets look like, and apparently investors do believe that Tesla's actually going to make those.
And so what does this all come back to as well? It still comes back to the Fed, and I know we're going to talk about this more in a second, but it comes back to the policy pathway and the tenor that the Fed has signaled. If they have signaled and given language to the markets that perhaps the worst of the rate hiking is behind us, and now we're getting to more of a stable period where the markets can anticipate what the Fed may do without having to fight the Fed, then you're going to see a continued rally in some of the very names that have really led the way thus far in 2023. Tech stocks, most importantly, because they were some of the most battered as the Fed was initiating the end of their easy money policies as well.
I mean, you have to wonder when it comes to some of these tightening conditions for small businesses, where we're going to start seeing people pulling back. It might show up. I mean, maybe you won't then going for that more expensive car if you have to sort of tighten the purse strings. And, you know, Teslas aren't cheap, that's for sure. So
I have to get a car first, Rochelle. Thank you.
That's all right.
That MTA subway pass works real well. The Fed's preferred inflation gauge cools in February compared to the prior month. However, this isn't the only inflation story turning heads, as profit margin-led inflation grabs the attention of central banks. Here to lay out the latest economic picture, we've got Paul Donovan, who is the UBS Global Wealth Management Chief Economist. Paul, great to have you here with us today. You know, as we kind of round out the first quarter of 2023, if there's kind of one common denominator or one major theme that rings true or resounds in your mind, what would that be?
Well, I think it has been the development in terms of inflation, that so much of the inflation story is behaving exactly as expected. You know, the transitory durable goods price inflation of 2021, early 2022, that's gone. You know, we're in complete deflation territory. You've got falling durable goods prices in the States.
We're in deflation versus disinflation, Paul?
No, deflation, outright falling prices. So disinflation is when the inflation rate itself comes down. Deflation is when prices are lower than they were this time last year. And that's where you are with durable goods. With energy prices, there we've got disinflation. We've just seen this in the European numbers. It's starting to drag down the headline. What we are left with is, in certain sectors, companies expanding their profit margin, telling customers, look, we've got to pass on these price increases, but they're not passing on the price increase. They're pricing on the price increase and a bit more. And that is now the last leg of the inflation story. And frankly, it's something which I think the Powell Fed has not really properly addressed in its policy discussions.
So then when you look at some of the Fed speakers who are coming out here, then how much does that complicate the picture here when you're trying to figure out where is inflation versus some of these companies just passing on these extra costs? As you're saying, prices are coming down.
Well, so what we've got here, I think, is a lot of relative price moves. So there are some sectors of the economy which are suffering quite a lot, where you're seeing either disinflation or deflation. You've got other sectors of the economy where companies are passing on the profit margin expansion. I think the problem, particularly with Fed Chair Powell, is that Powell tends to take a very, let's say, economics 101 approach towards policy, which is inflation up, I must hike rates. Well, the problem is with profit-led inflation, that's not necessarily the best approach, because it's not excess demand that is driving this inflation. It's pricing power, and an unusual pricing power on the part of some companies. And the fact that they're able to spin a fairy tale to convince customers to accept the price rises. So I think a more robust explanation of what's going on with inflation, if not from Powell, from someone who's a qualified economist at the Fed, that would actually be quite helpful, I think, in helping consumers resist some of these profit expansion price rises.
And so, yes, companies, they are continuing to raise prices, or have to, either because wages higher or the supply chain, for what they were able to lean on before and saying that the supply chain effects are causing them to raise prices. Much of that, even if it has been mitigated, they're still continuing to maintain price where it has been. So how much longer can consumers, or should consumers, expect for prices to remain elevated, or will they start to abate even more at a rapid clip as they push back on where price increases have been put into the market?
Well, what we've been seeing actually is a fantastic storytelling exercise. So wage costs are rising. Well, no, they're not. Real wages are collapsing in the United States. It's been a disastrous 2 years for real wage growth. Supply chain problems. Global supply has never been as high as it is today. Global trade exploded in 2022. Global manufacturing output keeps hitting all-time record highs. But it's a good story. What we're now starting to see, I think, are two things. Firstly, consumers, particularly lower income consumers, are running out of the savings from the pandemic. They're finding it harder to access credit. They've got falling real wages, and that's starting to subdue demand, and that will help to subdue the profit-led price story. But secondly, consumers are actually starting to wake up to this. Not quite yet in the United States, but we've been seeing this in Europe, for example, where in the Nordic countries, both Norway and Sweden, food prices have actually started to come down, at least for certain items, because consumers are just saying, hold on, this isn't fair. We're not paying this. And politicians, once they hear consumers are upset, obviously also start to get involved. So I think we're on the cusp of consumers starting to rebel a little bit against some of these profit-led price increases. And that, combined with the economic necessity forced by these 2 years of very, very negative real wage growth, that's going to, I think, accelerate a process of disinflation over the course of the next 3 to 6 months, I would say.
So, Paul, then I wanted to get some of your Q2 expectations here, your outlook here for how you expect the Fed to move. Obviously, investors seem to be expecting a pause, perhaps a little bit too early at the moment. But what are your expectations for Q2?
Well, if I was running the Fed, I would have paused already. But sadly, because I've got a British accent, I'm not allowed to run the Federal Reserve. So we've got to try and guess what Powell is going to do. And the honest answer is I don't think Powell knows, because we do need to assess what degree of bank lending tightening is going to come through over the course of the next few weeks and months. Now, bear in mind, we've been seeing a tightening already. So credit standards in the States and indeed in Europe have been tightening for several months. But if that process accelerates because of the events of the last few weeks, then that's something which would cause the Fed to pause in its tightening cycle. Now, I would slightly to the optimistic. Frankly, we don't have the data at the moment to be able to make a really informed decision. But just looking at who is doing the lending, what the constraints are, what middle-income families are doing, I would incline slightly to the optimistic in terms of this position. And as a result, I think the Fed has got one, probably two quarter-point hikes left in it. I'm not sure that's a good idea, but that's a wholly separate question. I think we've probably got a one or two rate hikes in the second quarter.
Well, I certainly feel your pain. I have to take running for Fed chair off my bucket list as well. A big thank you there to UBS Global Wealth Management Chief Economist Paul Donovan. Thank you for your time this morning. Right, the crypto winter seeing a hot spot with Bitcoin. The volatile digital currency finds itself with a roughly 70% gain thus far this year as the industry continues to face scrutiny from US regulators. Bitcoin sets its eyes on closing out its best quarter since the 3 months ending March of 2021. That's after what was a brutal 2022 for the crypto market. Be sure to stick around when we take a deeper dive on Bitcoin's market moves later this hour.
All right, everyone, and coming up, shares of Nikola are heading downhill after announcing a $100 million stock offering. We'll discuss that, plus have the opening bell on Wall Street. That's coming up next.
The opening bell on Wall Street coming up shortly, sponsored by Tasty Trade. Let's take a look at those markets. As we're seeing just in early trading here in pre-market, all three positive across the board at the moment, sort of drawing this collective breath as we come to the end of the quarter and the month. As we've been mentioning there, it's been a very rocky couple of months here, and especially with this last banking crisis, wondering how markets are going to really wrap up the end of this quarter.
Yeah, a quarter that certainly has benefited from a few things. The banking crisis, not one of them, but certainly a rebound in semiconductors as a subsector within technology and technology as a whole. The Nasdaq 100 getting in back to a bull market here, but also on the back of PCE, core PCE, which is less volatile than CPI, which is why the Fed likes to look at it. That coming in increased today by about 0.3% there for personal income there. So we'll continue to watch that. Here's a look at the opening bell on Wall Street.
All right, well, let's take a look at how the markets are faring as we kick off this final day of March. As we can see, they're green across the board. We see the Dow there up about 0.33%, the S&P up about 0.25%, the tech-heavy Nasdaq opening with the strongest gain so far, up about 87 points so far.
All right, let's take a look at where the markets have opened up here on the day as we were taking a look at the major averages there a moment ago. And I want to pull those up here on the screen. And if we could just toggle back over to it. OK, somebody might be logged in. As of right now, though, you've got the major averages up across the board for the Dow, the Nasdaq, and the S&P 500 as we were coming into the start of this trading session here. Also want to take a look at here. I'll pull up our heat map here so that we can ultimately get a view of what is taking place within the other sectors as we begin today's activity. All right, they're the U.S. markets. Thank you, somebody, for helping me out in the control room there. Dow up by about 142 points there. S&P 500 up by about 0.3% out of the gate. And then the Nasdaq composite, you're seeing about 25 points added there as of right now, 0.2%. Rochelle, I'll toss things back on over to you at the desk for right now.
All right, thank you, Brad. Well, let's check in on what's trending at the moment. We have shares of Virgin Orbit Holdings in the red after announcing it will lay off 85% of workers. In a filing with the SEC, the space launch startup said in order to reduce expenses, they will be cutting approximately 675 employees.
All right. So Virgin Orbit, I mean, we've talked about the cost for every single one of these launches just a few weeks ago. This was a company that essentially had to say, all right, we're going to furlough everybody or make massive changes to the number of people that can actually come to work just so we can figure out if we have enough in order to make sure that we can pay everybody. So for corporations, it gets into a legal challenge if you are ending up bringing people into work and unable to pay them, as we've kind of discovered with everything that had ensued with some of the banking crisis that had taken place for those regional banks. But as it pertains right now to Virgin Orbit, the number of flights that they were looking or launches that they were looking to have in order to put satellites into orbit, just in order to make sure that there's a connectivity play that they can monetize and profit from in the future, it doesn't even look like they're going to be able to fully get to that point. This was another one of those companies that had made its debut, I believe, in 2021, even as a spate of SPACs had made their entry into the markets here. Virgin Galactic, of course, Richard Branson's one of his other Virgin entities. They were the initial or perhaps one of the poster children of that SPAC wave. But Virgin Orbit, the other entity here, certainly just mired in some larger question marks here with regard to how much it's going to need to operate and where it could find that funding from.
And you have to wonder what this means for the space race. Obviously, you had Jeff Bezos, Richard Branson, Elon Musk really competing in this space here. So it's interesting to see that Virgin has now taken this route, having to take some of these cost-cutting measures and really seeing where they go from here. SpaceX still continuing, especially we saw that they really were thriving off of the back of the Russia-Ukraine crisis. They were able to position themselves in a better way that perhaps Virgin Orbit has not been able to. So interesting to see those declines there.
Yeah, it cost them about $12 million per launch here, essentially. And they had done 5 launches of the Launcher 1. But they had run into issues with some of the other launches actually being able to take place on time, or just running into mechanical issues along the way as well. And so we'll see what more the company has to provide going forward from here.
We'll definitely keep an eye on that. Let's also check in on shares of electric truck maker Nikola after the company said it will offer up to $100 million worth of stock to the public via a traditional secondary offering. Now, this is an interesting one here. Nikola, we We talk about it, but it sort of tends to be in the background sometimes here, Brad.
Well, for good reason. I mean, this is certainly one of the larger fall from graces. And after this company had made their debut, there was a lot of fanfare around what they could do in the semi-space, the type of more sustainable vehicle and truck that they were trying to put on the roads as well. However, then became the subject of one particular short research report that had come out and really put out allegations which were ultimately true and led to a conviction of their founder, Trevor Milton, and then just an entire revamping of how this company would need to operate and what was actually true about its marketing materials as it was even securing funding and going out to investors. And so the misleading and the fraudulent claims that had come forward about what the company and how fast the company was going to be able to achieve some of the goals that it had set forth, or at least pitched to the street, that really was the cloud over this company, and it has continued to be, and that's shown up in the stock price, and our viewers have just seen it there on the screen with the rise and then fall of Nikola over the years as well. And so I think within the stock offering, the move that you're seeing here today, that's typical with this, a dilution of the existing shares that are out there. And so now the stock reacting to that announcement here on the day, down by about 14.5%.
And I mean, they closed at an all-time low on Thursday. They're expected to sell that stock at a 20% discount. So obviously in a tough position at the moment, and how much they were planning on raising, instead going with the share splitting as a strategy instead. I mean, they're expecting to sell about 29.9 million shares to the public at that offering price. Nikola has been, obviously plagued with a lot of issues. It's really trying to compete in a space in electric freight that you really have. Obviously, we have Tesla trying to make that move, still waiting to see the fruition of that with their semis. But Nikola here with a chance to position itself and not seeming to be able to take advantage of that.
And another company that we're watching here on the day, we got to talk about BlackBerry. BlackBerry out with a miss on revenue estimates in its latest quarter as the company hits hurdles in closing cybersecurity software deals. Yes, you heard that right, cybersecurity software deals. Now, what BlackBerry has been focused on for a few years now, as the company has kind of taken on more faces than Arya Stark, at the end of the day, forming an entity that can go on from here and really play in the IoT revenue space. They saw IoT revenue, Internet of Things revenue, come in at about $53 million. Cybersecurity revenue, which we had mentioned a moment ago, come in at $88 million there. And that's really kind of the leading revenue driver right now for the company that brings in about $151 million in total revenue, at least in this most recent quarter here. They also had a new patent sale transaction that was pretty considerable here for up to $900 million. You imagine that would be a big boon to their business if that was able to kind of fully be executed over the amount of time that that deal is set forth for as well.
And a lot of people thought BlackBerry was down for the count, but really lent into its cybersecurity business. And you figure, especially with the rise of things like generative AI, even more important than ever as we sort of see some of these data issues coming up, companies needing to protect themselves, some of these threats increasing as well. So definitely a bigger play here for BlackBerry.
Yeah, I mean, this is kind of a business that has transformed from being one that everyone kind of carried around in their pocket on the smartphone basis that, had the kind of annexation or the connotation of being crackberry because you always had it in your hand.
Yep.
And then also had played in even the automotive landscape as well in their QNX business over the years, and then additionally now making this pivot into cybersecurity. And so we'll see where that continues to create material offerings or just deal-making ability for them to be able to stay in existence and continue to compete in this market.
We'll keep tracking that. I do still miss the buttons on the phone, though. Still miss that.
I do kind of too.
All right, everyone, coming up, Bitcoin surge has been given a big boost this quarter. Jared Blickery has the latest next. Welcome back to Yahoo Finance Live. Let's take a look at markets here. All green across the board. The Dow losing a little bit of ground here, though. We're seeing the Nasdaq still ticking up, though, about 0.5%. And the S&P 500 also seeing gains. So still buying action for the Dow, but a little bit slow. Early on in the trading day, let's also get to Jared Blickery at the Wi-Fi Interactive for a check on the volatile crypto market as it looks to close out an interesting month.
Yes, crypto has been a leader this year. And so let's get into the charts. We'll get to crypto in a second. I want to focus on the indices, everything in the U.S. and Canada, by the way, in the green. And let me show you what's been happening for the week. The Dow is up, let's see, over the past 5 days, 2.4%, and the Nasdaq is up 2.09%. So interestingly, the Dow is actually leading, which has not been the case for most of the year. In fact, you take a look at the year to date for the Dow as we close the quarter, it's just down slightly, basically break even, whereas the Nasdaq is up 15%. And we know the Nasdaq 100 entered a bull market only a couple days ago. Let me show you the price action, what's happening in the sector action today. Real estate, it was a leader yesterday, a leader today as well. It's up 1.3%. Consumer discretionary, that's XLY. Communication services, staples, industrials, financials, all of those are on the top row here. As you can see, everything in the green. Tech is the biggest laggard, though. And let's take a look at the Nasdaq 100 real quick. A few red spots, but not seeing really anything too major. AMD, by the way, down about 2.3%. Tesla up about 1.8%. Moderna up 3%. But let's get to the crypto stage here. Bitcoin. You know what? I'm going to go back here 2 seconds. This is our leaders, and I want to show you something related to crypto. This is year to date. Bito, that is my proxy that trades in the U.S. Markets here for Bitcoin. That is up 68%. And remember that Bitcoin has often been a leader in the risk markets over the last few years and has been reacting to Fed reports and inflation reports in the right direction as stocks, but even more so. That, in other words, the magnitude has been greater. So interesting to see that playing out. So let me get back to our crypto page. You can see Bitcoin up 71%. That is the underlying. And I'm going to put a 3-year chart so we can get a bigger picture view here of exactly where we are. 28,000. Let's see if we can go back there. 28,000, not a real big level in that I'm seeing in my work. 30,000 is kind of the next one that we're seeing. But it was able to clear 25,000, and that was a huge, huge sticking point. So let me just dial this down to a 6-month chart, and we can see up and away to the upper right. As I said, a couple more thousand, and we're going to hit 30, and that's where the rubber meets the road, guys.
All right, Jared, let's talk another area of the markets that's seen some gains this month as well. You actually wrote about this sector in today's morning brief. So this is up now on the Yahoo Finance homepage, but give us a deeper dive into some of the bigger names in the field that have come out of the gates and sprinting to start the year.
Yeah, broadly, we know that the Nasdaq has been the leader. Well, I guess I just said that a few minutes ago, but remember a few years ago, before the pandemic, maybe in the midst of it, but really going back to 2017, when we'd hear only a few stocks are driving the entire stock market. Well, that was the case, but guess what? That is back. Tech stocks, just a handful of them. In fact, in the case of the Nasdaq 100, 10 of them driving 88% of the Nasdaq 100 gains this year. And that falls under the familiar names Apple, Microsoft, Meta, Amazon, Alphabet, AMD, ASML, AVGO, that's Broadcom, Tesla, and NVIDIA. So a lot of chip names have made their way into that upper spot in terms of market cap. So interesting to see that play out. And I prepared those. You can see this chart in the morning brief, play around with it. But basically, the lower this is here, the worse the performance was last year. The more far right it is, that is the better performance this year. So this bright purple spot right there, that is NVIDIA up, what would I say, 85, 90% this year, but it was a dog last year. This is Meta, this is Tesla. So you can see there's been a huge comeback story, particularly in some of these mega cap names. And that's really what I'm focusing on, because when you think about what the bond market has done, it kind of crashed in March with that banking crisis. Well, that facilitated the tech trade, because people getting ahead of the Fed saying, all right, they're going to cut rates. This favors the growth trade. We're going to get back to low rates. Yeah, it's a good story, and it might happen, but I think people are getting a little bit ahead of themselves. So a little bit of caution is warranted here. Just think about the timeline. The dot-com bubble, that took 3 years. That was a 3-year bear market. We're barely into the second year here, guys.
As you mentioned, there a bit of caution, a bit of patience. Great stuff there, indeed. Thank you so much, our very own Jared Blickery. All right, continuing to watch the big turnaround in tech. Our next guest says that as the markets continue to be volatile, the tug of war between tech and bank stocks. We welcome in Sylvia Jablonski, Defiance ETF's CEO and CIO. Thank you so much for joining us this morning. So talk about this tug of war and how investors are playing it.
Good morning, and thank you so much for having me. Well, I think Jared did a really great job covering what we've seen in tech. And I think, so many of the tech stocks were just absolutely beat up last year. So you can say that in the last few months, the froth had been taken off of tech. And then if you think about investors and their mindset about, the Fed perhaps being closer to the end of rate hikes and being closer to being finished than starting, coupled with a bank collapse, that actually did provide a tailwind for some tech stocks. But then, this week was super interesting. We started the week actually with a lot of confidence brought back into the banking system. So you had the Citizens SVB story. You had, a lot of government officials coming out and saying that the backstop for banks is there and essentially really trying to put out this fire. And I think they did a good job putting out the fire. And then what you saw was that a lot of investors in the beginning of the week took some of those tech gains, to Jared's point. I mean, you have some of these stocks up 70, 80% starting into this year. And perhaps allocated back to banking, which had been beat up. But my sense of this is that it's kind of going to revert to the mean. I think you'll have this ongoing volatility. Today's inflation read was sort of just fine. We're at 4.5%. That didn't go away, but at least it wasn't too hot. So we'll have stability in that tech trade. Longer term, I think it's smart to sort of diversify to all of these areas, but I actually don't think the tech trade is dead. They're not near their 52-week highs, for example. We're kind of at 27 multiples down from 33. So I do think that there's a little bit of room to run, given that rate hikes are meant to pause.
In the event of a recession, are there areas within tech that are most resilient, especially considering the fact that you would have a lot of those large companies that we were talking about that have made up for the majority of the gains here that are very much intertwined within consumer technology and there's discretionary dollars that might continue to dry up for the average individual or household, or even for the business spending that could dry up on the other side of that on the web services side that many of them have been accustomed to seeing really line their profit margins?
Yeah, that's a great question. And I think, I've been thinking a lot about this with tech. I would argue that tech has already been in a recession basically for the last 14 months and is coming out of it. And all of the things that you just described have actually happened. So could this happen again if we come to a screeching halt and we do see more than a soft landing? Then absolutely, I think we'll be in the same boat that we were a few months ago, really, and tech stocks will fall and the whole market will pull back. But in my mind, those will just be great opportunities to continue to dollar cost average into tech. To answer your question a little more specifically, these tech companies, those top 10 that a lot of us talk about, the Microsofts, Apples, Amazon, and so on, they have strong balance sheets. They can weather a recession. Maybe we won't get that 10% growth out of them. But if you're looking for a stock that you have patience to hold for a few years, why not keep something like that on your balance sheet? That you're not going to have, like a bank run type of situation on an Apple or Microsoft, for example. They pay out some good dividends. They're the future of AI. They're the future of innovation, cybersecurity, cloud. So I think that tech has a lot of room to run, actually, especially with rates falling. And I think that spending is going to pick up. If we have a recession, I suspect it will be shallow enough. And I think that some of that spending is actually going to come back into tech because it's been on hold for the past year and a half.
And Sylvia, I mean, we've had guests say the Fed should have paused already, perhaps should have, started cutting rates by this point. How do you position yourself and what are you steering clear of as you try and make sense of this volatility?
I'm steering clear of trying to guess what I think the Fed will do, and I'm going to just start listening to what they're saying because I think, for a long time, we just didn't believe that. We didn't believe the Fed, and we still kind of don't believe the Fed, but the messaging hasn't changed. I think the difference, though, is it kind of doesn't matter. It doesn't matter whether or not they hike another 25 bips at this point. I think what matters is if they hold it higher for longer, when does that unwind come and at what point does it come? I do think that the last level of messaging that we heard suggests that they are very aware of what happened with the banking crisis. But then again, maybe that was just a blip in time and it doesn't impact inflation that much. So then the Fed continues to hike. But still, I think we're closer to the end than we are to the beginning. I'll just listen to what they say. And on pullback days, I'm going to pick up the names that are most hurt. when they rise rates, because I do think we're coming out of this eventually. And that goes to tech and semiconductors.
Sylvia, in your notes, you say that telecommunications is now essentially a subset of the tech industry. Help us break that down and the thesis behind it very quickly.
Yeah, so if you look at what happened, when we think about the hot topic of this year, it's been very much AI. And if you think about the staples that help AI work, they're the big tech companies that are investing in AI, and then the semiconductor companies. That's why they're catching the bid. They're a major component of the AI, revolution, innovation, whatever you sort of want to call it. But if we think that, some of the semiconductor stocks have benefited a lot and they have a ways to go, but maybe they're closer to, the end of their rally, you can look a little bit further down and look at the communication stocks, right? So you need 5G to actually power AI, machine learning, innovation. So start thinking about companies like Verizon, AT&T, T-Mobile, Skyworks, American Tower, some of the REITs that actually are necessary to, the property REITs that are actually necessary to power all of this. I think if you look at, what kind of powers 5G, what powers speed and lower latency, it goes beyond just semiconductors. So I just started looking a level down and thought, some of these top telecommunications stock are going to be a big winner of the AI revolution going forward.
Does that mean that they should also have the same or similar PE ratio?
I don't think so, because they're still classic communications companies. I just think that they're going to benefit from a technology trend. So I do think that they'll get, additional revenues, perhaps an additional margin expansion because of AI, because of innovation, because of machine learning. But, that'll come with time.
Sylvia Jablonski, always a pleasure to speak with you. Thanks so much. Defiance ETF CEO
Thanks for having me.
and CIO. Appreciate it. And coming up, how airlines are faring as FAA staffing shortages causing a little turbulence. Strap in. We'll discuss next. If you're one of the nearly 50% of Americans set to travel more this year, according to Forbes, be prepared to account for some snags with the airlines. The last summer and winter seasons saw issues with everything from FAA computer failures to piles of unclaimed baggage. But as this year's peak season approaches, the question remains, is the airline industry set for 2023? Here with more, we've got Anthony C. Roman, AC Roman and Associates founder and CEO. Anthony, pleasure to speak with you as always. All right, help us kind of get a grip on what we're going to have to wade through in the peak travel seasons this year.
I think we're going to have a terrible travel season come spring and come summer when the passenger demand absolutely surges. The airlines, beginning in the mid-teens, really failed to look at the immediate future and develop the software improvements, hardware improvements, but most importantly, the looming retirement age of the baby boomer pilots at 65. In the next 2 to 3 years, there's going to be massive retirement numbers, and there are not sufficient pilots to replace them. It takes years for pilot training, and then the experience necessary to become qualified to train as an airline pilot. So the airlines have really dropped the ball on this, particularly the low-cost airlines that attempt to keep their budgets low. The larger airlines doing better in this regard, but certainly not perfect.
I certainly got a taste of that when I was traveling this week. Numerous delays when I was traveling. I mean, you would think off of the back of COVID and sort of some of the problems that we saw over the Christmas and December break there, that some of this would at least start to get resolved. But are any lessons being learned here? And what can they really do timeline-wise, given how long it does take to train new pilots and new staff?
I think the lessons are stinging for the airline industry. And again, the larger airlines are doing better in this regard. But during the pandemic, and particularly in the first 2 years, the pilot retirement rate and the pilot early retirement incentives provided by the airlines resulted in a massive loss of pilot numbers. And there just was not any planning or significant preparation for the sudden surge in demand following the dwindling of the pandemic restrictions. So the airlines are really in a dilemma. One of the programs that they have initiated that has been looming in the background and is time proven to be safe are accelerated pilot training programs, shortening the amount of time, not the amount of training hours, but the amount of time it takes to qualify a young pilot for the right seat, the co-pilot seat in an airliner. Now, the airlines also have to improve infrastructure. All of the new personnel, particularly the ground personnel, and you layer on top of the new ground personnel who are somewhat inexperienced in dealing with passenger problems and passengers being upset, you also have the necessary security at the airport, which has improved in terms of moving passengers through those checkpoints, but still is an annoying process for the passengers. Then you have inexperienced ground personnel acting in a public relations and customer service role. Then the shrinkage of the seats, both in width and in legroom, and the pressure of the pandemic, the cancellations, and you have a very angry customer base, not looking pretty.
Indeed. And I mean, even during the pandemic, we saw that a lot of pilots were getting furloughed, a lot of airline staff there. So they don't really feel that incentivized to come back. What is the need for some of these pay increases? Are you seeing some of these companies, especially larger carriers, stepping up when it comes to some of these pay raises so that we don't see some of these strikes continue to then exacerbate the current situation?
Yeah, that's another element, that the airlines are finally increasing the pay and providing signing bonus incentives to young pilots to join the accelerated training program and to make the industry and that career path more lucrative. It is very expensive to become a new and young pilot. It takes years, and training in those aircraft costs a lot of money. The airlines are now contributing scholarship-like payments to new pilots in the accelerated programs, and have begun negotiating increases for the current pilot staff that are in place. But for the next 1 to 3 years, there are just not enough pilots to go around. If a captain or first officer on a scheduled airline gets ill, there may not be another pilot to replace him. That flight's going to be canceled. Superimposed on that, you have some terrible weather this year. We're getting very strong weather fronts. That's a natural cause of delay. And then the FAA has the same problems as the airlines in a lag of upgrading their infrastructure, particularly software and hardware, which has resulted in some episodes of nationwide delays.
And so I want to talk about JetBlue because obviously they decided to reduce the number of flights coming out of New York and then also the merger with Spirit there. Is that going to help or hurt this current situation?
I think it's going to really be an ongoing problem, regardless of what's done immediately now. It just takes time to resolve these deficiencies that have occurred since the mid-teens, despite the forecasts being exactly what they are, that passenger demand was going to increase and the looming retirement age was present. The pandemic really gave it the knockout punch, and that has what caused these massive delays that we've never seen in airline industry. Now, a handful of the larger airlines, which have much more infrastructure, which did invest in infrastructure improvement. Airlines such as Delta, one of the largest, if not the largest airline in the world. If the passengers spend the time to look at the cancellation rates, the delay rates of each airline, which is all over the web and perfectly available, they'll be able to choose those airlines which have a better record. Now, that does not guarantee that they will be on time or that the flight will not be canceled, but it'll improve their odds. It may cost a little bit more, but it may be worth it.
Yeah, that's exactly what I was going to say, which is that it's not going to guarantee that you're going to get a good price on that ticket, since that's a core marketing component for a lot of airlines. Anthony C. Roman, AC Roman and Associates founder and CEO, thanks so much.
My pleasure.
And coming up, how Trump's indictment could impact the 2024 presidential race. We'll discuss with two experts next. And welcome back to Yahoo Finance Live. I'm Brad Smith alongside Rochelle Akufo. We're taking a look at markets at the top of this, the 10 a.m. hour on this Friday, the last trading day in March and the last trading day of the quarter here in 2023, the first quarter to really kick things off. And the Dow Jones Industrial Average over that 3-month period, net lower just barely by a fraction of a percent. It depends upon how things end out the day. But as you're seeing right now, the Dow holding on to gains to start the trading session. First 36 minutes of trading, it's up by about 0.5%. We were also taking a look at the Nasdaq Composite a moment ago as well. We've got some gains on the screen there that we're continuing to keep tabs on. The Nasdaq Composite up by about 0.5% here. And then additionally, we were checking in on the S&P 500. I can toggle on over to the 11 sectors in the S&P 500 to really get a glimpse of where that's faring. As of right now, year to date, it's up by about 6%, but here on the day, intraday, up by about 0.5%. Let's toggle back on over to those 11 sectors, though. As of right now, you're seeing more gainers than decliners right now. As XLK, that's been leading the pack year to date. Let's put this on an intraday view, and all 11 S&P 500 sectors are in positive territory on this final trading day and session of March. And you've got consumer discretionary that's actually leading the pack as of right now, 1.1% in positive territory. XLK is actually pulling up the caboose in terms of gains on the session, however, still net higher. And just pointing out or zeroing in on tech for a hot second here, as that's up just barely in the green. Let's take a look at the Nasdaq Composite here. You also had an interesting take from Citi out today, and particularly zeroing in on the global tech sector. They had actually upgraded the U.S. to overweight along with the global tech sector. They downgraded global financials to neutral, given the cyclical nature there. And so ultimately taking a look at some of the banks here on the day as well. You've got some mixed activity there. However, the large banks really holding on to some of those fractional gains as of right now, Rochelle.
All right, great stuff there, Brett. Thanks so much. Well, Donald Trump becomes the first U.S. president in history to face criminal charges. It comes after an indictment from a New York grand jury investigating a hush money payment, allegedly, to an adult film star in 2016. Here to discuss what may be in the cards for the former president and the potential implications to the U.S. economy, we have Bill Crystal, the Bulwark editor-at-large, along with Greg Valliere, AGF Investments Chief U.S. Policy Strategist. A big thank you to you both there. So, Bill, I first want to start with you. I mean, we knew this was coming at some point. Markets don't seem to be that bothered by this at the moment. What are your big takeaways here as we're looking at this and the potential impacts for markets and the economy?
Yeah, I mean, maybe the markets have discounted one or multiple, I would say, likely indictments of the current, more or less, frontrunner for the Republican nomination. But I do think it is unprecedented. And I do think it's potentially destabilizing one way or the other. I mean, you might end up, from the market's point of view, with a better nominee and with the rule of law reasserted. You might end up with Trump strengthened and rioting in the streets. I hate to even say this, but it's, of course, quite possible. There will be several indictments. I think the one thing we know is there will be several indictments. The second thing we know is we don't know what's exactly going to be in them, what new evidence there'll be, what the reactions will be, what the reactions to the reactions will be. And so I think we're at a time of pretty real uncertainty going forward.
And Greg, what would the markets make of any of the other Republican representatives or party members kind of making their own position outright around what's taking place with former President Trump, as that could signal where the inclination for the broader party might move in the future and the economic implications there?
Well, I think an awful lot of the other Republican candidates were like Pavlovian dogs last night. They just immediately reacted by embracing Trump and criticizing harshly the New York DA. So I think that this helps Trump win the nomination. It does not help him at all in terms of winning the general election. But I think he's probably unified the party, ironically, through these. And Bill's right, there are going to be many more indictments to come.
And Greg, to follow up on that, I mean, we saw how difficult it was for Speaker McCarthy to get his position, the concessions that he had to make. What does this mean then for the debt ceiling then? Do you think we'll perhaps get even more pushback, or could we get some more moderate in the GOP, perhaps trying to find a compromise so that we don't end up at that X date and end up in a situation that we've not been in before?
I mean,
well, if you want me to take,
yeah, that's a good question. No, go ahead. I'm sorry.
So, Greg,
I would just say the problem. The problem is not getting a deal. You can probably get a deal. The problem is there are many House Republicans, radicals, who don't want any deal. They wouldn't vote for anything. So it's still, in my opinion, is a real threat to the markets.
Yeah, I mean, the way I'd put it is there are two possible reactions to this, basically, in the Republican Party. One is, oh my God, we cannot continue going down this path, and a little bit of a strengthening of those forces that still exist in the Republican Party, which are not as strong as they should be, for responsibility and for not, blowing up the system one way or the other, either politically or economically. The other reaction can be just a continued radicalization of the party. You would have made money the last 6 years betting on the radicalization scenario. I thought after January 6th, and even I thought, I guess I could say, after January 6th, that maybe the party would come back to its senses. It hasn't, to be, from my point of view. But we don't know what the effect of these indictments will be. But I do think that there's more chance. The two tails are stronger than they used to be. It could either be radicalization or maybe a reaction against the radicalization.
And Greg, I mean, when we think about the other cases here, those are even more potentially explosive. You think about the Georgia case and looking to overturn election results there, the classified documents in Mar-a-Lago, and then you could even look to the incitement or the alleged incitement of the January 6th riot here. I mean, even if this case does not hold up as strongly as prosecutors are looking for, what do you anticipate of the others set to come?
Well, I think if we do get these other three cases leading to indictments, which I think is quite likely, we could by late summer, early fall be talking about Trump fatigue in the Republican Party. You have to ask the question, how much more could they possibly endure? I think I'd be interested in Bill's comments because he's so well plugged in. If Trump starts to fade, if DeSantis doesn't really catch on, there has to be another lane or two lanes for another nominee or two. Could it be Youngkin? Could it be someone a little more liberal? I mean, I've got to think there's still an opening for one or two additional candidates.
And Bill, I want to have you weigh in there.
Yeah, I've thought that for a while. I think that lane, exists. I think it's a 10% chance of probability of being successful or even really truly competitive compared to Trump's, 50% and DeSantis' 40% chance of being the nominee. But you've got to think at some point it could be that a plurality, if not a majority of Republican primary voters say enough with all this craziness with Trump, enough with even the culture war stuff. Can we have a more normal Republican governor? Can we have Brian Kemp of Georgia? Can we have Glenn Youngkin of Virginia? They both seem to be pretty competent governors who got elected in swing states. In Kemp's case, reelected easily in a state Biden carried, after all. But I got to say, as I said earlier, if you betting on that scenario of people coming to their senses has not been a good bet for the last few years.
To what extent would any candidate then have to answer for any of the prior Republican president, which was President Trump, those policies, either in the retracement or the retraction of Dodd-Frank that's led to, or at least perceived to have been blamed for some of the banking crisis that we're navigating through right now, or even in some of the broader economic impacts that have taken place because of some Trump policies?
I mean, I would say that you could argue this is an opportunity, right? You get to embrace some of the good parts of deregulation, say that maybe they went a little too far. If you're a fresh face like Youngkin, business experience, you could make a case that you end up in a sweet spot. You could also make a case that 10, 20, 30% of the party who are true Trump loyalists are furious. They refuse to vote for Youngkin. They vote Trump third party. I mean, this is where it's not so easy to just stitch this coalition and hold this coalition together, even though in theory one could sort of write that scenario.
And Bill, just to follow up, so we're looking at DeSantis here saying obviously that he's not going to participate in any sort of extradition. Talk about his positioning there, especially how the business community might be viewing this, given the strong stance that he's taken against Disney, and if he does become the potential front runner.
I mean, for me, that extradition comment is really a blatant just promise. I mean, it's not serious, because Trump's going to give himself in, presumably. But if one were to take him seriously, and he is the governor of one of our largest states, and he'd said this in his own name, so maybe we should take it seriously for a second. It's a promise to violate the law, to violate the Constitution. And do we want to set the precedent? Incidentally, if you're a business corporation operating in 50 states, the judgments in one state could just be ignored in others. Is it criminal? Do we want to set the precedent that if you commit a crime in one state and you go to another state and the governor happens to have a different view of what that crime is, he just says, I'm not extraditing that person? That really is chaos. And so I think the recklessness of the kind of statement that DeSantis made should really give people pause.
Bill Kristol.
And I would just add, if there's been a surprise in the last few months, it's not true. We all knew these indictments were coming. The surprise has been that DeSantis is not quite as formidable as most people felt. And I think his comments on Ukraine, even though he walked them back, could haunt him for quite some time.
Interesting. Bill Kristol, who is the Bulwark editor at large, along with Greg Valliere, who is the AGF Investments Chief U.S. Policy Strategist. Gentlemen, thanks so much for joining us here on The Day. We appreciate it. Micron under the microscope as China looks to examine conduct a cybersecurity review of products sold in the country by U.S. memory chip manufacturer Micron. China noting that the move is aimed at safeguarding national security and protecting the security of the supply chain for the critical information infrastructure. Now, shares of Micron down roughly 3% today. Coming up, Intel is doubling down on its chip production timeline. We're going to discuss with the company's head of data center and AI. That's coming up next.
Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while. But then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
Let's take a quick check of the markets, sponsored by Tasty Trade. The Dow, the S&P 500, and the Nasdaq are all in positive territory right now. The Dow higher by about 150 points thus far in the session. 0.5%, we'll round that off to. S&P 500, that's up by about 0.5% as well. About 20 points there. In the Nasdaq Composite, you're seeing gains there by about 0.6%.
All right, well, Intel is doubling down on its chip production, announcing that its new service market product will come sooner than expected as it looks to reclaim market share losses. Intel's data center and AI group executive vice president and general manager Sandra Rivera joins us now. Good to see you. Good morning there, Sandra. I mean, looking even at how good to see you. Looking at how the stock has performed even over the past week, up more than 10% here. Talk about what investors are reacting to.
Well, basically the fact that we are operating in a large and growing TAM with the digitization of everything, every part of our lives, we need more high performance computing, and that's the business that Intel is in. Also, the fact that all of our leading indicators for our future products that are coming out to market are looking great. And so we're back to that predictable execution of high quality products and leadership capability that our customers count on. So they've been quite excited about that. And then lastly, with the growth of AI, and especially the growth of generative AI and all of the continued growth in computing that represents, and our opportunity to capture more of that market, I think our investors are quite excited by that as well.
Yeah, and we saw that this week, especially given the webcast that Intel had put forward, really discussing some of what you just laid out. The rest of the names in your space also moved higher. And so when you think about the data center and the role that AI plays within that, where is kind of Intel's either bread and butter or competitive positioning, would you say, going to be in comparison to the rest of that market that's hearing about this total addressable market that you're seeing elevated, and even through 2027, the larger opportunity where Intel is kind of the beneficiary of that versus some of the others in the space?
Yes, well, we see the market as largely a market that's growing for mainstream compute, and then a market that is growing for accelerated compute. In the mainstream compute market, the CPU, where we have leadership and the largest market position, it is the workhorse of the data center. So the CPU, the workhorse of the data center, and our Xeon CPUs are in the leadership position. The other area that we have been investing in that mainstream compute is all of the integrated acceleration that we put into our Xeon CPU for the high growth workloads like AI, of course, but also networking with the build out of 5G and edge computing, also security, where you're trying to address data privacy and securing customer data. So that is another area where we built in acceleration into our CPU and where we have a leadership position, and all areas of high performance computing. So mainstream compute is all about the CPU as the workhorse, and that's where we have a strong leadership position that we've had for a number of years, and then even stronger now with this accelerators that we've built into our portfolio. Then when you look at accelerated compute, where clearly areas like generative AI, you need more of these parallelized architectures. That is the domain of the GPUs and the AI accelerators, especially for those very large language models that we hear about in terms of ChatGPT and other of those very, very large, high compute intensive environments. And that's where we also have a great portfolio of GPU capability and our AI accelerators, where we're showing that we have leadership performance over the most popular GPU in the market, as well as a better price per TCO or performance per TCO value that we are delivering to our customers. So we're playing in all aspects of computing, mainstream compute, accelerated compute. And again, this is a large and growing TAM, and Intel absolutely seeks to unlock more value for our customers and earn more of their business.
And I want to talk about some of the opportunities in generative AI. Obviously, we know that there is the petition signed by Elon Musk and Steve Wozniak and others really concerned about the highest. These are the strongest levels of AI. You have the weaker assisted levels of AI interaction, and then the strongest where it's almost self-realized generative AI. What's your take on that? And is this the right approach to take that pause for 6 months as you compare it to, say, other emerging technologies where we haven't done something like that?
Well, I think that the issues that are being raised around ethics and bias and what gets built into the algorithms, they're all valid issues. And we do need to examine those. And particularly when we think about data privacy and a lot of what we get concerned about in terms of misinformation or deep fakes and some of those technologies. Our job is to deliver innovation to the market and to ensure that we have a broad range of developers, that we are that we're operating in an open and transparent way. And our entire AI stack, in terms of the software and the hardware, is built on open choice and trust, so that we are operating in a transparent environment. We are sharing openly in the open source projects, in the ways that we engage with the ecosystem and the developers to understand the technology, use that technology, but also provide security capabilities and choice in the market. We just believe that when you lower barriers to entry, you increase market participation and you accelerate the rate of innovation, and doing that in a trust and transparent way is really the best approach in terms of addressing some of the very valid issues that are being raised now.
For the companies that you deal with that are portfolio customers of Intel that would look at this opportunity, look at the new offering from Intel and decide to either buy into an elevated solution or have to put that cost off into a future date, when do you see Intel hitting critical mass within its AI group specifically, given that this would be another added cost for some companies that are already looking to cut costs in this near term, given some of the macro uncertainty that they're navigating as well?
Well, the thing about AI and machine learning and data analytics and statistical analysis and all of the technologies that are under that umbrella of AI is that they're not new. In fact, we've had these capabilities for many, many years, and we've been doing machine learning and data analytics for many years, and we built that into really our entire compute portfolio, starting with our CPUs. So the goal that customers have and businesses have is to increase productivity. And clearly, AI is a productivity enhancement tool. So as you're looking to run a more efficient, a more effective operation, one that is delivering more value to your customers, you are going to use AI, machine learning, data analytics, statistical analysis, and all of those tools are going to actually unlock more value and let you operate in a more productive way. When we look at just the portfolio of architectures and products available on the market, we are seeking to integrate more of that AI capability and machine learning capability in that CPU workhorse that allows us to enable customers to have some level of machine learning and some level of data analysis right in their workflow with the workhorse, Xeon CPU that they already have, doing a lot of that data processing that they're already doing in the environment. So many of these applications where you're going to use AI and machine learning are already part of the workflow, unlocking more productivity and effectiveness and efficiency for an enterprise.
Sandra Rivera, who is the Intel Data Center and AI Group Executive Vice President and General Manager. Thanks so much for joining us this morning.
Thank you.
And coming up, the outlook for Biden's cybersecurity crackdown. We're going to speak to the CEO of SolarWinds on the impact next. Growing security threats, including those from China, have pushed the Biden administration to call for better safeguards for U.S. critical infrastructure, including cybersecurity. Now, President Biden's proposed 2024 budget increases the Cybersecurity and Infrastructure Security Agency, or CISA's, budget to over $3 billion while boosting spending on several cyber initiatives, though there's a chance Congress could approve more or less. Joining us now for more on the mitigation of cyber threats is SolarWinds President and CEO Sudhakar Ramakrishna, who's here to discuss the use of artificial intelligence in cybersecurity as well as President Biden's cybersecurity goals. Great to have you here with us today. First and foremost here, people should know, for those who are unfamiliar, you assumed the role of CEO at SolarWinds. This was following the 2020 cyber attack. What were some of the biggest developments when stepping into this role that you saw as necessary or prioritized to change in how the company was operating?
First of all, Brad, thanks to you and the team for having me here. I'm delighted to be with you and discussing this very important topic for all of us in the broader community of technology and community in general. As I stepped into the role, I, first of all, like any incoming CEO, I assessed the cybersecurity posture of SolarWinds and compared it to my background, which was also in cybersecurity, and started defining ways we have to enhance, because the nature of the attack that SolarWinds had was very novel and sophisticated. And as you know, if a determined state actor is after the property of a private company, then 9 out of 10 times or 10 out of 10 times, they're probably going to break through. So we built a framework, which we call Secure by Design, that was comprehensive across infrastructure, application, cloud, security, keeping in mind the complexity that is emerging, as well as very focused on transparency, collaboration, and public-private partnerships. Because I don't believe any one company is actually capable of protecting itself, because we are fighting an asymmetric war here. And so those were some of the initiatives under the framework of Secure by Design that we implemented, and to date, we still practice those.
And Sudhakar, you recently hosted the Public Sector Partner Summit. So I want to ask about some of the conversations that you're having in the public sector and really how the investments that you're seeing match the threats that you're also seeing.
Great question. Thank you for asking that, because the public sector, the federal and the state and local governments are a very important constituent of our business, and they are experiencing significant and greater threats every single day. We've used a combination of technologies as well as integrations, and I mentioned the word public and private partnership, as well as the notion of community vigil. What's important, and you mentioned CISA in your opening remarks, is the involvement of CISA has been increased after Jen took on the role. And we have been participating very actively in President Biden's initiatives across instituting better security controls, better security hygiene and practices all across, both in the context of secure SBOM, as they call it, as well as broader security practices, including the use of AI. And everyone is determined to fight it, but we have to fight it together.
I'm going to tell somebody that their security hygiene is bad next time I'm able to get into their phone without knowing their password. I like that term. I'm going to use that. You know, at the end of the day, I think there's a lot of focus on where artificial intelligence comes into play for cybersecurity. This is not new. I mean, I've seen demos in the past of where artificial intelligence or augmented intelligence even has been layered into this approach. So what's new about it right now, here in 2023 versus 5 years ago?
Brad, if you look at every enterprise, they have two issues. One is complexity is growing, and their costs or budgets are not commensurate to the complexity growing. Added to that is the significant and constant security threats. And that's where AI comes into play. In our context, using our observability platforms, service management platforms, or broadly speaking, the SolarWinds platform, we've integrated AI ops to allow customers to improve their productivity and reduce their costs through simple mechanisms. One is, you may hear the term alert fatigue from people you speak to. People are getting too many alerts in the enterprise, and they don't know which ones to prioritize. And if you don't prioritize the right ones, then security holes and security threats emerge. So using AI and machine language techniques, we create alert stacking, which eliminates alert fatigue and helps the customer focus on the right issues to address. That improves their productivity and reduces the cost associated with security breaches.
Right.
Two, extending that on, we also help them predict what could go wrong and also help them root cause it so they can continue to improve their overall security posture.
So from the government entities that you work with, do you believe that the budgets have proportionally increased enough in order to keep pace with what you were mentioning ago in the number of threats that are now emerging either from domestic or foreign actors?
I'll give the government a lot of credit for making security a conscious topic amongst all of us and actually supporting us both in terms of policy as well as continuing to focus on budgets. Are the budgets sufficient? I'm not qualified to address that question, Brad. Are they increasing? The answer is yes. And this is where I am a very strong proponent of public and private partnerships, because as vendors, we need to continue to improve and optimize and help them increase their productivity as well. And so I see a sense of obligation on our side, but equally the government can share a lot of information with us where together we become more secure.
And just very quickly, in terms of where the threats are coming from, we know that China tends to be the name that comes up. Where else should people be aware of?
You know the usual suspects when it comes to state-sponsored attacks. You mentioned China's one. There's a few others. At the same time, with the advent of AI, there could be a proliferation of some of these because you can be a lone wolf and still use AI technologies to create threats. And so we have to be vigilant across both nation states as well as individual lone wolf attacks, small subgroups. And so this is a matter of constant vigilance and constant learning is the way I describe it in terms of security.
I do thank you for taking the time to join us this morning. SolarWinds CEO Sudhakar Ramakrishna, thank you so much.
Thank you.
All right, coming up, how economic headwinds are impacting the advertising space. We'll speak to an analyst from S&P Global next.
Credit default swaps, or CDS, back in the news, evoking memories of 2008 and the global financial crisis, as well as a Big Short movie, but we're talking about today. A CDS contract amounts to an insurance contract on a bond or a loan to protect against the risk of default. That's the credit and the default part, but we want to talk about the swap part as well, and that refers to the exchange of payments or cash flows between the buyer and the seller. Now, when the contract is initiated, the buyer will make an upfront payment plus maybe quarterly or annual installments, and the seller is only responsible for payment in the event of default. That is a credit event. It could be a missed payment on the bond, or it could be the company filing for bankruptcy. Who uses CDS? Probably not you and me, but large institutional bond managers with millions of billions of dollars invested, they of course want to hedge their risk in the market. And for you and me, quite helpful to know what Wall Street is watching and what keeps them up at night.
As consumers deal with inflation and other economic setbacks, spending in advertising has taken a hit. And with so much economic uncertainty, our next guest says visibility into trends is, quote, limited as advertisers remain cautious. S&P Global Ratings U.S. Media and Telecom Senior Director Naveen Sarma joins us now. Good to have you on the show here. So I want to first talk about this economic predictor that advertising has become as they really get closer and closer to the time when they sort of put in their advertising bids to when they actually make air and what that's actually signifying.
Yeah, it's actually a fascinating trend that's happened that's really accelerated with the growth of digital, because so much of digital is being sold programmatically. It's being bought closer and closer to airtime. We've seen that in the past with things like radio, which has been sold close to airtime. Television has always had a bit of a lag, but you're starting to see television as well get sold closer to airtime as more of that is being sold programmatically or being sold through streaming services. So the idea that historically advertising was a lagging indicator of economic activity is no longer the case. It's getting to be, on par with economic activity. What we saw last year was both radio and digital started to show significant weakness towards the end of the first quarter as we started to consider a potential recession or at least a macroeconomic slowdown last year.
What type of recession is advertising dollars predicting right now?
It's kind of unsure. So right now, our assumption, we base our forecasts off of our macroeconomic forecast, which is still assuming a bit of a growth this year, and that's a change from what we previously had. And so what we did was we went and changed our and actually slightly raised our forecast because we don't think it's going to be as much of a recession this year. But frankly, the lack of visibility into what's going to happen in the second half of this year is a bit of a concern because a recession could be worse, could be better, and advertisers are going to react very closely to what consumers are telling them.
So then, how strategic are advertisers having to be right now when they're making the most of their ad dollars? Where are they flowing that money into?
Yeah, it's a great question. I think you're seeing a pullback on digital, which is really transaction oriented or brand building. More importantly, you're seeing pullback there. But advertisers are also sticking to television because I think what they learned with the pandemic was if they cut back on brand advertising, especially on television, when the economy recovered and consumers went ahead and started spending again, they remembered the ads for the products that they saw, and they didn't, and they pulled back on buying products that didn't advertise. And so advertisers have this constant this constant thing going on where they have to pay attention to what consumers are doing, but they also have to be well aware of what consumers will do once the economy recovers.
We had also spoken with the CEO of Pinterest regarding where their business is seeing some either challenges, but also where that's able to grow out because of the advertising base that they still rely on as well right now. I want to play a clip of this and then get your reaction on the other side.
It continues to be choppy out there, but I think I've talked about this on our last couple earnings calls. In each of our last couple earnings calls, I talked about how even in a choppy market, we can still go take share. And I think that's what you've seen in each of our last 2 quarters, was that we grew faster than the broader market.
So kind of pairing that with what you had said a moment ago, who are the biggest winners where you do see, and as you are seeing that shift from some of the traditional kind of cost per click or digital ad dollars versus the now new streaming opportunities where you've got a kind of Netflix ad-based tier and what have you, where there are eyeballs that they can easily go for there in this kind of broader screen wars, if you want to sub it up that way, quest for advertising dollars?
Yeah, it's actually 2 separate questions. So the digital players like a Pinterest or a Twitter or guys like that, they will. You're going to see shifts in market share. I think the bigger winners on the digital side are clearly going to be Meta and Google because they do have the broadest reach out of all of these digital operators. You're seeing a lot of experimentation going on with a lot of these, call it smaller or secondary digital platforms. And so money might move around just based off of, things that are going on, like Twitter has had issues recently and they've lost ad dollars and they've gone to other platforms. And so you might see market share shift that way. But I do think the biggest winners there are the big global platforms, Meta and Google. On the streaming side, I think the additional inventory actually helps advertisers as well as the media companies because you're seeing declines in audience share for television. But if those eyeballs are going to streaming services, now a company like a Disney or a Warner Brothers can go to an advertiser and say, we can offer both television as well as streaming, and you can get a much broader reach. And so I think that benefits those companies.
So as we head into the second quarter, then, what are going to be some of the top 3 trends that you're watching in where ad spending is going?
Well, it's going to be driven by macroeconomic trends, right? So we're assuming that the second and third quarters are going to be where we could potentially have a recession. So we're going to have to really pay attention to what advertisers or what media companies are telling us. In a way, it's a bit difficult to try to look at the quarter and try to draw any conclusions because, especially for television, there isn't the big programming, either sports or some kind of event that people are going to watch. And so you're going to see audiences decline in the second quarter. So really what we're going to have to see is what's going to happen in the third quarter when the NFL and the new TV season starts. And we're going to get a bit of a clue from the upfront, which will start to get placed in the second quarter. So maybe the upfront is the thing to pay attention to in the second quarter. But really, it's given that advertising is becoming so close to airtime, it's really what happens during the summer.
All right, maybe just less of the Meta Platforms metaverse ad, which was kind of creepy. S&P Global Ratings U.S. Media and Telecom Senior Director Naveen Sarma. Naveen, thanks so much for the time.
Thank you for having me.
Coming up, everyone, tensions between the U.S. and China escalates as the battle over TikTok continues. We'll discuss that next. Chinese telecommunications giant Huawei reported its biggest annual profit decline ever this morning, blaming pandemic controls and U.S. technology sanctions for the almost 70% drop. The company's finances have been significantly hampered by the U.S.'s broad restrictions against Chinese companies passed last year. Those chips are critical for smartphones, AI, and advanced tech, but U.S. leaders are fearful China could use them for military purposes. Now, in 2020, Huawei was the #1 smartphone business in the world, but subsequent U.S. chip restrictions, as well as a COVID-19 policy in China, very restrictive, kneecapped their business. Since the shutout, China has prioritized domestic production of chips, but experts say they have a long road ahead of them. Joining us now with his thoughts on the technology rivalry between the two countries, the U.S. and China, we've got Gordon Chang, who is the author of The Great U.S.-China Tech War. Gordon, always a pleasure to speak with you and get some of your insights here. All right, help us really kind of set the scene for where post-COVID-19 policies in China and the reopening of the economy there, where the IMF had projected the Chinese economy as well as India would be the top 2 growth areas in the world this year. Set the scene for where we're actually pacing now that we're actually a quarter into the year at this point.
Yeah, March might be a good month for China. We're starting to see the purchasing managers indices, especially the one for services. But this comes after a disastrous January and February combined period where we saw exports drop 6.8%. But even more worryingly, Brad, imports, which show really domestic demand, fell 10.2%. And that's after months of export and import drops. So the Chinese economy will recover this year because last year was so bad, but the recovery is probably not going to be as good as it once was. And one of the things about Huawei, yeah, they can blame the United States chip restrictions, but also I think they should be blaming the state of the Chinese economy itself.
And that is a fair point. I do want to ask you about the TikTok ban, obviously just part of a broader discussion about the US and China tech rivalries and also concerns about data there. Now, we did see that this fast track to ban the app was blocked, really sort of under the framework of free speech being violated here. I wanted to get your take on that and really how TikTok plays into the China-US discussion.
Well, the Restrict Act, which is working its way through Congress and which has the support of the Biden administration, does raise serious First Amendment issues. But with regard to TikTok, there has been a series of untruths told to American regulators, to the US Congress, and to everyone about data security, as well as China using the app for propaganda purposes. And so I think that essentially what we have is the ability of the administration to use, for instance, the International Emergency Economic Powers Act of 1977 to ban it. That would not raise the First Amendment concerns, or especially forcing a sale to a U.S. party, which would have no U.S. First Amendment issues at all. So there are things that the administration could do, but is not doing because it's waiting for the Restrict Act to give it authority.
From your perspective, then, what is the best solution for how to engage with ByteDance subsidiary TikTok from any international regulatory perspective, if you did have a fear that there is indeed some type of use from China for either propaganda or for either data tracking?
Yeah, I think the best thing to do would be to force a sale to U.S. parties who control the algorithm. When the Trump administration tried to do this during its last months, when they tried to force a sale to Oracle, the deal actually cratered not over price, but over control of the algorithm, the one that curates content, because Beijing was using TikTok to amplify its propaganda. And so that's what's critical to the Chinese. And what we have seen in the comments from the Ministry of Commerce and from others in Beijing is essentially that this algorithm is going to be the core of the issue.
And I do want to ask you, because obviously the comparisons between TikTok and how it shares data potentially with the Chinese government, and then when you also have, Meta, you have Google also collecting this data, sharing it with third parties. A lot of us don't know where our data is going. Is a ban the best move versus a blanket national security data law that covers all of them?
Well, first of all, Meta and Google, they're private parties, and people can contract with them and they can agree to have their data sold or whatever. What's happening with China is different. TikTok has been saying that its data is secure, but as we know from the BuzzFeed reporting of last June, that nobody at TikTok US had access to the data. The only parties that had access to data were in Beijing. So this is a much different issue of government control versus two private parties contracting with each other, the big platforms and users.
You mentioned former President Trump, and there's, of course, a lot of political prognostication that's taking place today on the news around his indictment. But with that, there's a larger question as well of if this does indeed somehow give him more kind of political power in one way or another, or at least sway. Does that mean that the U.S.-China relationship would become even more fragmented in the future?
I actually don't think that it doesn't really matter who's going to get elected in 2024. There is going to be this whole relationship and the tension is driven by what China's doing. So, there might be some marginal difference if you had a Trump or a DeSantis or a Newsom or a Biden or a Harris. The point is China's driving this. And so I don't think that be much different. There will not be much difference whoever is in the Oval Office. There are certain of those candidates who would have a tougher position on China, but that might actually be good for relations in the long run because the Chinese respect strength and they don't respect the opposite of that.
We'll certainly be tracking that. Thank you so much, Gordon Chang, now author of The Great U.S.-China Tech War. Thank you for your time this morning. All right, still a lot to come on Yahoo Finance today. Coming up in the next hour, Jared Blickery will continue to break down the indictment of former President Donald Trump as he's joined by Margaret Carlson of the Washington Monthly.
And Caleb Silver from Investopedia will join the show to discuss top performing assets and stocks as we wind down the month of March and thus the first quarter. You don't want to miss that conversation.
And then later in the day, former NBA MVP Giannis Antetokounmpo and John Kodonis, the CEO of Calamus Investments, will join Dave Briggs live from the New York Stock Exchange as they ring the closing bell and launch their new sustainable equity funds.
Oh my goodness, I think I still have my NYSE pass, so I might have to see if that badge still works today.
There you go.
If Giannis is going to be there, I got to be there. Jared Blickery's got you for the next hour of trading. Stick with us.
Welcome to Yahoo Finance. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Jared Blickery. Here's what I'm watching. The nation feeling the fallout from Donald Trump's indictment. It's the first time that any U.S. president, former or current, has faced criminal charges. We're going to break down the story and all the next likely steps. Plus, markets end the quarter on a positive note. The S&P 500 reclaiming the losses from SVB's fallout as investors feel more optimistic on the outlook for the banking sector. We look to the next 3 months with Investopedia's Caleb Silver. And Bitcoin was the best performing asset in the quarter, but the fixed income market has seen some notable moves and changing interest rate expectations. We talked to treasuries this hour. But first, let's check in on the major indices. It is an up day to close the quarter. We got the Dow up 178 points, S&P 500 up about 0.6%, Nasdaq just a smidge more there. And just checking in on the treasury market, we're also seeing a little bit of movement there. And if we can get there, we go. We see the 5-year down to 3.66%, the 10-year moving down 2 basis points to 3.53%, and the 30-year down 3 beeps as well, or bips. In our top story this morning, former President Donald Trump indicted on criminal charges over the alleged cover-up of hush money payments made to Stormy Daniels during his 2016 presidential campaign. The payments were allegedly made to keep Daniels quiet about a relationship with the former president. The charges have not been made public. Still, legal minds are questioning the strength of the case. And here with more is Yahoo Finance's Alexis Keenan. So a little bit of a surprise yesterday evening, and we are dealing with it today. We don't know all the details, but what do we know?
Right. So the reason why we don't know the details is because this indictment has not yet been made public. We're expecting to see it in the coming days. So it's all speculation right now about these charges that are supposedly associated with these alleged hush money payments that Donald Trump made to porn star Stormy Daniels, $130,000 worth of payments. That was back in 2016 on the eve of the presidential election. And so this investigation, though, brought by Manhattan District Attorney Alvin Bragg, it's just one of 4 probes that various jurisdictions have been making into alleged wrongdoing by Donald Trump. But there are reports that in this case, there may be up to 30 separate charges. But still, there are some legal theories here being challenged. And there's a lot of talk among the legal community about whether or not these particular charges would stick. And the reason is because Alvin Bragg, as Manhattan DA, he's responsible for charging state charges, right? Not federal charges. And in this case, the thinking is that Donald Trump could perhaps be facing, in connection with these hush money payments, falsifying business records charges. Those are New York state charges, and also violations of federal campaign finance laws. So federal charges on one hand, state on the other. There's questions over whether or not the state charges can sort of be bootstrapped into federal charges and whether those can be married together in the same type of case brought by an Alvin Bragg. So if that's the case, these hurdles are also involved with the statute of limitations. That has to do with how long a prosecutor has before they need to bring charges to the table. Now, in this case, if you look at the New York state law for falsifying business records, that has to be brought, charges that have to do with that have to be brought within 5 years for the felony level charge on that particular violation. We are now 7 years out from that 2016 payment, alleged payment, I should say. So there might be a problem that this case can even be brought at all on that particular charge. Now, also, in the case of falsifying business records, that's usually a misdemeanor. It can become a felony, but in order for it to become a felony, it has to be coupled. There has to be a payment made with intent to make a false, not a payment made, a false business record made. But then you also have to intend to commit an additional crime by making that ledger in a business record. So the question here is whether that other crime, that federal crime, can be, again, married together, whether or not a judge would even permit that to happen, and also whether a judge would permit Bragg as a state level prosecutor prosecuting state crimes to charge this federal crime. So also, you wouldn't have a grand jury convene on a misdemeanor. That's not the way grand juries work. They are interested in investigating felonies. So a lot of questions here if these are the particular counts that the DA is looking at.
That is a lot to unpack, so I really appreciate the report, Alexis Keenan. And we want to continue our coverage of former President Trump's indictment over the cover-up of payments ahead of the 2016 election. And joining us now, Margaret Carlson. She is a contributing editor at the Washington Monthly. Margaret, great to see you here. All right, you just heard Alexis break down. It looks like there's some thorny issues with respect to potential statute of limitations, federal charges versus state charges. What's your big picture thought here?
I was listening. My assumption is that if it wasn't a felony, the indictment wouldn't have been brought. That the connection between the misdemeanor and the campaign finance has been made. And just even those of us who don't know campaign finance law, and I include myself in that group, I think the underlying presumption of this is that if this had been known, if there hadn't been a payoff, somewhat illegal, probably campaign funds or Michael Cohen laundering some money, Trump wouldn't have been elected president. There's a good chance he wouldn't have been elected president if this had come out. So that's why I think they've got the goods to make it a felony.
All right. Well, let's think about the future here. The minute I heard this, I thought, okay, what are the implications for the stock market? I wasn't thinking of anything in particular, but then someone threw out the possibility, and I've been reading quite a bit about it today, that, of course, we have the debt ceiling negotiations going on. And with Trump, I would not say the presumptive nominee for the Republicans in a couple of years. Probably nothing is presumptive as to what's happening or what would happen then. What do you think? How do you think this comes down in terms of the debt ceiling and any other political wrangling that there might be in the House and Senate?
You're so right. We can't make any presumptions right now. It probably doesn't affect the functioning of the House. We know where Kevin McCarthy stands. He stands totally foursquare behind Trump. I don't believe he thinks that this indictment is going to weaken his hand with the White House. He's a creature now of his right wing, the Marjorie Taylor Greene wing of his party, and they are adamantly opposed to raising the debt limit. How this is going to work out, no one knows, because, under Trump, the debt ceiling was lifted 3 times, no fuss. It always is a bargaining chip, and then it gets raised, because if you don't raise it, the United States defaults for the first time, and there's chaos in the financial markets. I think the market went up over 100 points today. I mean, it would fall thousands of points. It would be disastrous, and it would be so costly that in the end, I think the party that's arguing against raising it and trying to use it as a bargaining chip gives in. Also, by the way, let me just add,
sure,
McCarthy hasn't asked for anything specific. So Biden has put out a budget. McCarthy hasn't put out any specifics about where they would make these cuts that they want to make. So it's a real standoff now without even knowing what the bargaining chips are.
Yeah, let me ask you, in your opinion, or if you can cite the opinion of some experts that you're talking to, how does this affect Trump and his re-election or his election hopes for the future here? Is all publicity good publicity? This is going to get his name in the press a lot, and I haven't seen, personally, I don't watch the news. I'm on Twitter. I don't see him on there. So he's been out of the news cycle for me for quite some time. I'm just wondering, in your opinion, does this get him back in it? And is it good for him?
As much as Trump wants us to think it's a good thing because it galvanizes his followers, the word indictment still carries a lot with it, and it's all negative, to most Americans. Now, maybe his hardcore followers are so enraged that they become more passionate about him. But I don't think there are enough of them for this to be the help that he said it was when Trump first heard that there was going to be an indictment and started fashioning his response to it. And I've been in a lot of courthouses. I've been in a lot of police stations. People there are hired for being stone-faced and being kind of unreachable. And when Trump goes for his fingerprinting and his DNA and other things, the idea that, it's not a situation where you say, do you know who I am? And then expect better treatment. Everybody gets the same treatment. And guess what? It's cold and unfeeling and a not good feeling. So that's what he goes through first. I think it chastens anyone to be on the wrong side of law enforcement as you go through the process, and he'll be busy. You can delay pretty much if you have high-priced lawyers, you can delay for a while. But I don't know if you delay all the way through. I think there'll be appearances and other things that, will make him not look so good walking into a courthouse. When Paul Manafort was traipsing in and out, it didn't elevate him for most of us. As I said, there will be a hardcore that will be angered by it and will be more loyal. Well, but I don't think that's enough to win.
I really appreciate your insights here. There's a lot to be learned here. We're going to wait for that indictment. And thank you for joining us, Margaret Carlson, contributing editor at the Washington Monthly. Coming up next, markets end the quarter on a positive note. The S&P 500 reclaiming the losses from SVB's fallout as investors feel more optimistic on the outlook for the banking sector. We look at the next 3 months with Investopedia's Caleb Silver. Welcome back. Markets set to end March on a high note, despite pressures from the recent bank failures. And here to break down the best performers amid the banking mayhem is Yahoo Finance's Ines Ferre. Ines, take it away.
Jared, technology, communication services, those are the big winners for this quarter, and anticipation of a Fed pivot, perhaps lower interest rates going forward, yields on the 10-year coming down a bit, the U.S. dollar index coming down a bit. All of this has really helped fuel that tech rally. I'm going to pull up on our Wi-Fi Interactive a year to date so you can see technology, XLK, XLC, up 20% for each. Over on the Nasdaq 100, the mega caps on the left-hand side of the screen. These are the big winners. And you can see the biggest winners, Meta up 74%. You've also got Tesla that's up 60% and NVIDIA up 87%. Is that another way, Jared? I know that you put a really neat chart up so you can see the top 10 NASDAQ 100 stocks in 2023 accounting for 88% of the gain. So you can see the breadth of this rally sort of contained to those big names. As far as losers for the quarter, well, there were plenty of those, but those are more contained within the following sectors. Energy down 5.7% for XLE, and of course, financials. XLF down 6.5%. And within those financials, the regional banks are really the biggest losers. And if you just pull up an equal weight here, you can see FRC, this is First Republic, down 88% for the quarter under tremendous amount of stress after the collapse of SVB and also Signature Bank. And then finally, I just want to pull up our trending tickers because here is where you kind of get individual storylines, also sort of highlighting the liquidity or credit crunch, as you will, or funding or lack of easy money. And this is where you see equity sales going forward. So Nikola just announced that it will be having an equity sale and it's down 12%. But year to date, you can see down 43% for Nikola. Then you've also got, I want to show BBBY, Bed Bath & Beyond, because that is also down for the quarter considerably. It's now trading like a penny stock after tapping the public markets yesterday, warning that if it didn't consummate a stock offering, that it would face bankruptcy. Another company that's now trading like a penny stock, down about 15%. Can't find it on the chart right now, but nevertheless. Jared?
We believe you, Ines, and really shocking to see those regional bank losses for the quarter there. Thank you for that.
Thanks.
Investors are highly anxious. That's according to Investopedia's Anxiety Index. That data suggests cautious activity ahead as investors look to curb their risk appetite amid the rise of market volatility and uncertainty around interest rates. Here to weigh on in investor sentiment as well as trends for the quarter is Investopedia Editor-in-Chief Caleb Silver. Caleb, thank you for joining us here. You were just listening to Ines recap the current quarter here in the year, but I want to get to the investment survey that you sent out there. Some really interesting searches popping up at the top of this list, some of which I haven't seen since the global financial crisis.
Yeah, it's fascinating to see what investors are looking to learn about, and the past quarter, even the past few weeks, has brought up all kinds of obscure terms that we normally don't care about or pay that much attention to. So Minsky moment, right. Again, we haven't heard that one in about 10, 11 years. Fancy word for a hangover, too much cash going into the system. What happens when that cash gets taken away? The contingent convertible. Thank you, Credit Suisse. Everybody wondering what happens to those contingent convertible bonds that Credit Suisse owned that now are in the hands of UBS. Is my 401k insured? All this banking crisis bringing people to that anxiety about what happens to their money if their bank gets seized. So they're wondering about their 401k. That's not the FDIC, that's the SIPC, as we know. How to buy the yuan. This is new as people are worried about the dominance of the dollar, given the Saudi Arabia-China arrangement, everything else going on, the BRICS. Now also some folks looking to be very promiscuous. As we went through that banking crisis, they were looking for the top bank ETFs to play and buy the dip there. Also some folks looking for the inverse of the bank ETFs to try to play the downward spiral there. But also CDs, money markets, all these things popping that are in investors' consciousness right now, given the environment.
Yeah, really interesting to see a lot of those names popping up. Want to ask you about your sentiment survey. What are investors feeling? In general, there's been a lot of caution around the market, but it's interesting to track the ebb and flows. You take a look at the the AAII survey that just came out, the results of that. Investors aren't really believing the rally so far, so maybe the pain trade is up. But what is your result? What are your results?
Yeah, it's the rally that everyone loves to hate. So you have this greed on the one hand, pulling people into the promiscuous names, but also into the Nasdaq 100, and Nez laid that out pretty well. Nasdaq 100 is powering into a bull market here, but you also have that fear on the other, and that's the CDs, that's the money markets, 500 billion going into money markets in just the past few months. So you have that going on, but 49% somewhat worried. That shows us those of us that are caught in the middle between fear and greed saying, I don't feel so great about this. 31% expecting more losses this year, only 11% thinking we're going to have gains, and a lot of people leaning into those money markets and CDs. Only 51% say they're going to wait this out, but you also have those promiscuous folks on the edge wanting to buy the dip, looking for names that they can latch onto.
Yeah, I want to move on to some of the best and worst performing stocks here. And if we start with the worst performers, not surprisingly, we're going to see First Republic there down 88%, some other banks, but it wasn't only banks there.
No, not only banks, but it was a terrible past couple of months for the banks, but I see a Dish Networks there. Comerica, that is also a bank, but if you continue to go down that list, you see a lot of names that are maybe getting punished because of sector relation or relationships to banks, some of the lenders there, but we have had a nice little rally in the banks since a lot of the smoke has cleared for the time being. Your banks, though, your regional banks, worst performers there. Your best performers, though, again, that is the home cooking stocks, right? Plus NVIDIA. Everyone loves NVIDIA. That stock's up 85% for the quarter. But just look at what's happened with Microsoft and Apple. They've become the safety trade. They've become a lot of a safe haven for investors that want to put money to work. But even the Teslas, Warner Discovery, this one surprised me too. One of the top performing stocks so far this year.
Yeah, really interesting stat. I just read that Apple and Microsoft together now constitute 13.2% of the S&P 500. First time since the 1970s, 1978, that only two stocks have had that much influence. Back then, it was Ma Bell and IBM,
right? Yeah, IBM and AT&T, right?
We read the same newspapers here. We had time for one more. I'll give you the floor. Anything interesting coming up? You're editor-in-chief of Investopedia. I'll give you the floor here.
Yeah, we are constantly fascinated with what people are looking for. So we're constantly tracking sentiment. We're also tracking what people are searching for and their level of anxiety. And how do we track that? Through what we call the anxiety index. This is fear-based terms that spike outside of their normal range around the economy, around personal finance and the markets. So people are really concerned, not about the markets right now, but about their money in the bank. So searches for FDIC, why isn't my 401k insured? Who's protecting anything above $250,000? We're watching that anxiety and seeing if it plays into consumer habits and investor habits. So far, it hasn't, because we have a nice little rally going on here, but I'm interested to see if investors get a little bit more conviction going into the next quarter and for the rest of the year, because there is a lot coming up in terms of earnings, in terms of a potential recession that we're going to have to battle with.
And sentiment can always change on a dime, as we've seen many times over the last few years alone. Really appreciate your insights, Caleb. Caleb Silver of the Investopedia editor-in-chief. All right, checking in on the markets here, sponsored by Tasty Trade. We want to take a look at the Dow, which is up 223 points, S&P 500 up a little bit more, about 78 basis points, and Nasdaq, that is up almost 1%. Coming up, are the fears over stability of the banking system, are they really over? We're seeing a drop in emergency loans to banks from the Fed, so that's a good sign. We're going to dive into that story up next. Welcome back. Looking back at the banks, the high-profile failures of not only Silicon Valley Bank and Signature during the March bank crisis were in part caused by rising interest rates, but recent research suggests it wasn't SVB's unrecognized losses or capitalization that caused it to fail. Let's look at one key indicator of bank failure with Amit Saru, the Stephen and Roberta Denning Professor of Finance at Stanford University. Amit, thank you for joining us here today. Lay this out for us, because we've been hearing a lot about all these losses, unrealized losses, that is, losses that banks haven't put necessarily on their balance sheet just yet. But that's not necessarily the case with, or that wasn't necessarily the biggest cause of the downfall for SVB, because other banks had bigger unrealized losses. So what was the culprit here?
Yeah, thanks for having me. So in a study with several of my colleagues, what we find is that there was turbulence on the asset side, like you said, for many banks because they had a lot of unrealized losses. But what really matters as well is if you have the flight risk, which is how many depositors do you have who can get spooked and start running. And it turns out that Silicon Valley Bank, while it was on the extreme, is not the only one in the study that has flight risk. And if you marry the turbulence on the asset side with the flight risk, what you will find is that there is more than one Silicon Valley Bank out there. And so we got to worry a little bit about the fragility in the banking sector. And, you saw the Fed come up with pretty unprecedented sort of steps. And part of the reason is, I think they realize that there is some fragility in the system.
And so I've heard some rumblings that the Fed may take a different tack in their macroprudential approach to some of these banks that operate in very specialized capacities. So if you say SVB is an outlier, maybe the Fed starts looking at other outlier banks. Do you see this as a way to potentially contain the problem? Just wondering if that or any other ideas have been thrown out that you've heard of.
Yeah, so, there are too many banks in this situation to resolve with one-off solutions is my view. So if you look at these conditions, this insolvency situation is across the banking system, and government backstops sort of have stemmed the problem for now, but it's laying the seed for potential problems, pretty much like the savings and loan crisis. So you got to think a little bit ahead, further down the game tree, and think about what is a reasonable solution which fixes this problem in the system. And one way in which you could address this is by, at some point in the near future, requiring banks to go out and raise equity capital. Because what that will do is it'll give you a market test to figure out which are really the insolvent banks out there. And we'll also get some skin in the game for banks. Those who are solvent will survive, will get some government backstop. But those who are not solvent need to be weeded out of the system. Otherwise, we are looking at a prolonged saving and loans crisis once again if we don't do anything.
Well, that's really interesting. I quote or paraphrase Warren Buffett here. It's only when the tide goes out that you can see who's swimming naked. And having to raise capital seems like a pretty good way. Just wondering then, would this be a blanket policy? Everybody has to go to the capital markets and see how you fare. How is this implemented on a regulatory level?
Yeah, I think before the market tells you which bank they think is solvent or not, you don't want to discriminate. So you want everybody to go out and raise capital. We have information on how much shortfall or unrealized losses there might be in the system. And essentially, you need to ask banks to fill the void and not just rely on government backstop. A temporary fix right now is fine, but we can't expect this to be a permanent solution. There have been lots of proposals right now being extended in the House and the Senate, where you want to insure the entire banking sector. We are talking about trillions of dollars here, like an additional $9 trillion of insurance provided through taxpayer money. And that doesn't seem a reasonable and a viable solution, especially if you have a lot of banks which are kind of zombie banks right now. So you don't want the zombie banks to prop up through these subsidies and insurance that we are providing. In the short run, it's fine, but in the medium to long run, we got to think about forcing banks to come out and face the market test.
Well, and that's kind of the way the market is supposed to work, weed out those malinvestments that have been made prior. You mentioned the savings and loan crisis a minute ago. A lot of people comparing this to the global financial crisis because that's the most recent one, or banking crisis in memory. Where do you see this falling? You could even go back farther to continental Illinois in 1984. Where do you see this landing in the spectrum of previous bank failures?
I think one thing which is similar to 2007 and 8 crisis is that a lot of banks took similar bets. The difference is those bets were different, that those bets were on the housing market through the credit, through the loans, that they had made. And as a result, also the banks had lent to each other. So when there was a spark in the subprime sector in the housing market, it led to a propagation through the banking sector, which was pretty leveraged. Here, it's a little bit different. You'd still see banks facing correlated shocks because they have all invested in these long-term securities, which have fallen in value because of the increase in the Fed rate. What's different is that it's not yet hit the credit side of the balance sheet. It's just these securities which have fallen in value. And if the uninsured depositors get spooked, they start running. And that then forces the bank to liquidate these securities, which can then have a ripple effect on the credit side. It's not gone there yet. But if it did, then there would be similarity to the financial crisis. So you might have seen some folks talking about the commercial real estate sector where maybe some of these ripple effects might show up, but they haven't yet. And that's what distinguishes it from the 2007 and 8 crisis. There is similarity with Continental. There is similarity with savings and loans crisis. I think savings and loans crisis is the most sort of similar in spirit, because that was again a scenario where banks took bets which were unhedged and faced interest rate risk. And because of the interest rate risk, the assets depreciated and the depositors wanted higher rates, and that led to a spiral. So pretty much similar to what we are seeing. But we have seen how you resolve these banks before it becomes a systemic problem.
We got to leave it there. Really appreciate your insights here. Amit Suru, the Stephen and Roberta Denning Professor of Finance at Stanford University. Coming up, domino effect. We stay with the banking story with one of the companies impacted by the SVB collapse. More on that next. Welcome back. One of the companies at the center of the SVB collapse is Tomo Credit. For more on how they've been impacted, let's welcome in Yahoo Finance's Ali Garfinkel. Ali, so give us a skinny.
So give us the skinny.
Yeah.
I don't know. I'm trying to remember the last time someone said that to me.
Oh, am I aging myself? I hope not.
So Tomo Credit, right? Yes. They're a fintech startup that's helping consumers who have less financial access build credit. And they've gotten a lot of buzz in Silicon Valley. They've raised about $130 million in funding to date. And they were intertwined with SVB at the time it collapsed. They actually have a $100 million warehouse facility with SVB that still is entwined with the bank. Now, I spoke to their co-founder, actually, CEO and co-founder, Christy Kim, and I was trying to understand how it had affected Tomo. But what was interesting is that two bigger themes really emerged. The first was that her case is that fintech is more important than ever. Fintech has, for instance, part of the ethos of fintech, right, is that the system isn't perfect as it is and can be improved. So that I think we have seen in full color. I don't know if I need to say any more on that.
Something's being disrupted.
Something's being disrupted, right? That's definitely true. But it's the case that she was making is that fintech, because of the ethos of it, because it is so devoted to the idea that we can do banking better, that's really where fintech can improve. And that made a lot of sense to me as a theory. The other thing, too, that was maybe the more salient point she mentioned, which was that the barrier to entry for fintech is actually going to be higher after the collapse of SVB. Now, why? As it turns out, SVB was an early key partner to a lot of these fintechs. A lot of them have business models that have never been tried, and SVB was particularly willing to try those business models out, do the due diligence, do extra due diligence, and try to figure out if they could really back these companies. So the banks this bank collapse is really going to leave a huge gap in that space. I'd actually love to read you a quote from Christy because I thought it really distilled the situation down. For an early stage company that's about to launch, it's going to be hard. For instance, if I were to launch Tomo Credit this year, I'd be absolutely screwed. There's just nowhere to go. And it's interesting because that support meant so much to me then. From a selfish perspective now, it can actually be a competitive advantage for Tomo because it's wiped out opportunities for a copycat to come out this year or next. So what she posited to me was fundamentally this catch-22, where clearly the ways fintech is looking to reinvent the system are important, but that those startups that are trying to get into fintech now are going to have more trouble getting a leg up than they ever have.
Not only that, guess what? Interest rates are higher. Cost of capital is up. That's affecting all startups, 100% of them. So,
and VC funding.
Yeah, definitely adds to that. So you actually got a chance to attend Shop Talk this year. What was the main takeaway from Shop Talk?
That's right, Jared. There is one key takeaway here, and it's that the AI hype cycle is in full swing. At Shop Talk 2023 this week, AI was everywhere, whether it was on panels, on the record interviews, or back green room conversations. But WonderCo co-founder and Hollywood legend Jeffrey Katzenberg had an unexpected take. I was joined by him and Natomi CEO and founder Puneet Mehta to break down how they're thinking about AI and where tech is at right now. Take a listen.
I think, like so many people, we look at the opportunities around AI and are genuinely excited about it. I think you're hearing from many of the grand wizards of our world, the Bill Gates, the people who have really been the pioneers in the last generation. I think everybody agrees that this actually may be the next defining moment in sort of our tech evolution, if you will. And with that comes incredible promise. Today, I think the enthusiasm that we're hearing, unbridled enthusiasm, is about generative AI and all of its applications around creativity and storytelling and art, and it really is quite spectacular. That's not what I'm interested in.
There's a particular kind of AI that you are a proponent of, Puneet, sanctioned AI. What does that mean?
So what sanctioned AI means is that you get to leverage all the great things that generative AI brings to the table, but in a fail-safe environment. So you need a safety net around it. You need to be able to enable what role does the AI play? Is it autopilot, where it helps customers autonomously, or is it co-pilot, where it's helping an employee? You need brand safety filters. What are the things it is allowed to say, not allowed to say? You need it to follow business policy and procedure. You need to be able to audit the work that AI has done with relative ease. And then you need escalation procedures where if it does something wrong, how do you have somebody step in and save the moment gracefully? So there are all these things that would apply to employees. Now AI, as it enters your workforce, you have to look at it as an employee. To make it productive, you need all these measures. So sanctioned AI lets you use all the amazing capabilities of generative AI, but for the enterprise in a fail-safe mechanism.
The chaos in tech versus the chaos in Hollywood. You talk a lot about the parallels between the two, and especially at this moment, I'm curious about how you're thinking about those parallels.
Well, I think they're actually quite different. And what I would say on the tech side of it is, if you look at 2010 to 2020, the impact of technology, digital technology across every facet of our lives has been beyond anything anybody could have thought of or imagined. From 2020 to 2030, I think the impact will be 10x what it's just been in this past decade, which we can't actually fathom. That's how gigantic. And so I don't see this as a troubled time for tech. I think it's a time of opportunity for it, and why I'm so excited about it. On the Hollywood side of it, it is a transformational moment in time. And they are in the process of transitioning into a new relationship with their customers. And it's not, I think, crystal clear yet what that relationship is going to be. How important are movie theaters going to be to their customers? You know, what is the place for digital distribution? What is the windowing of content? How much of it? Where? How is it priced? All of those things, frankly, are being redefined in this moment in time, with that some consolidation going on. And so I think the next 18 months is that time for it to reconfigure itself and have its next renaissance. I couldn't be more optimistic about the opportunities around content, content creation, content distribution in it. We're watching more television, more film, more video today than we ever have in our lives before in it, and that's not going away. If you are in business today, there are three things that remain essential for your health and happiness and continued prosperity. More, better, cheaper. Right? Those are the three things. Usually,
that all sounds pretty good.
Usually you're told you get to pick two, right?
But you think you can get three?
Yes, I think with AI and the proper deployment of AI, it is going to actually be an opportunity to do all three of those things.
We could look back at this moment, it might end up being the industrial revolution moment for tech, where AI ended up getting us to a place where there were new types of jobs created, there were new types of skill sets, the impact it's going to have on education, on healthcare. But yeah, we are most excited about how the enterprise is going to adopt it and really build that customer connection, that customer love.
That was Ali Garfinkel at Shop Talk 2023. Smaller banks are now getting a shock as bank clients look to move their funds to larger institutions, fearing insolvency in the wake of Silicon Valley and Signature Bank's collapse. Here to discuss the bank narrative in his own latest take on Bidenomics is Yahoo Finance senior columnist Rick Newman. Rick, break down your take, please.
Hey, guys. Guess what the most important financial release is these days? It's not the unemployment report or even the inflation report. It's something the Federal Reserve puts out each week called the H8 release. Hardly anybody used to pay attention to that, but that now tells us, that has a lot of banking data in there, and it tells us what's happening with bank deposits. And there's been a remarkable outflow of bank deposits recently for two reasons. One is that people are looking for higher yields in money market funds. That's been going on for about a year as interest rates have been going up. But the other obvious reason is that people got worried about whether their bank was safe after we saw these two bank failures early in March. So what's happening right now is we are just waiting to see if all of this stuff that the Federal Reserve and the FDIC and other bank regulators have done, if this is enough to stabilize the banking system. We heard President Biden this week, he said he wants to go back to the tougher standards for regulating mid-sized banks that were in place until the Trump administration weakened them. That will help in the future, but I don't think that's going to do anything if we still have wobbly banks in the system. So we are basically in a wait and see mode, and this could go on for months before we know the banking system has finally stabilized. Just as a reminder, the 2008 financial crisis actually started in 2007 when two hedge funds failed. That was an early warning that a lot of people did not recognize at the time, but it was a year later. Before the panic spread throughout the banking system. So it's not going to be that bad this time around, but this can take some time.
Yeah, I remember that. It was the summer of 2008. Two Bear Stearns hedge funds went down, and it was only next year, about 15 months later, that Lehman fell. So thank you for that, Rick Newman. Data out this morning shows the key measure of U.S. inflation cooled more than expected in February. Now, all eyes are on the Fed for their next move. And joining me now is Tom Tzouris, Managing Director, Head of Fixed Income Research at Strategas, a Baird company. Tom, thank you for being here today. Just kind of laying out where you see the markets right now. We've had this incredible bond market volatility, which has ebbed a bit, but we saw in March, over the month of March, rates largely crash and kind of settle down to where the levels where they are now. What's your picture look like?
Yeah, well, there's been two narratives, two stories in 2023. The first one to start the year was that inflation was sticky. It was coming in, it was coming down, but it was coming in at levels that were still well above what the Fed would consider comfortable. And we just got another inflation print today. And yes, it's come down a little bit, but it's still well above a level that we would call comfortable, about a 4.6%. And so because inflation was really clearly going to be sticky throughout this year, you saw the bond market starting to sell off again, and you saw yields pushing higher. And in particular, you saw short-term yields in the 1 to 2 to 3 year bucket really drastically pushing higher, upwards of 5% not too long ago. Then all of a sudden we get, as your guests have talked about, the issues in the banking sector, and that completely dwarfed the story of inflation. And you saw yields drastically dropping. And you saw at one point in time, 2-year yields dropped about 130 basis points in about 2 weeks, just an astronomical drop for this era that we're in. And now you're seeing 2-year yields backing back up again, about 30 basis points as the banking sector fears begin to ease a bit. So those two themes have been kind of competing off each other. And for now, as we sit here at the end of the quarter, we're looking at more or less the market kind of settling back into this notion of sticky inflation. And the Fed still has some work to do, but we don't really know just yet how much that work is and what they're going to do. Our base case right now is that the Fed does pause here with the Fed funds rate at 5%. And they do continue, though, to reduce their balance sheet. And that means yield volatility is probably going to remain elevated for at least another quarter, if not the entirety of this year.
Thinking about corporate credit spreads, a lot of times credit leads the equities markets, and we saw some spreads widen recently as a result of the banking sector troubles. But just overall, let's leave the banks out of this, especially the regional banks. How are corporate credit spreads looking in the U.S., I guess, compared to where they were about a month ago?
Yeah, so right now, for example, in the investment grade corporate space, you're looking at spreads about 140 basis points. And that is maybe 20 basis points below where we were a week and a half ago, 2 weeks ago. And so we've come down, but that's also about 40 basis points below where we were at the peak of October of last year, about 180. So spreads have dipped lower. And the primary reason why you've seen spreads dip lower this year is that the market does seem to be buying into this view that a soft landing in the U.S. is still something that can be achieved. If the market believed a recession were imminent, you'd see investment grade credit spreads about 2%, 200 basis points. So we're well off of those levels that would signal a recession. And I do think that even if the U.S. does enter a recession, it's not likely to enter it this quarter or next quarter. And that's likely to come later in the year. So there's some time, but we do expect spreads are going to widen out, rise this year, and eventually move back to that 180 to 200 level that we were at last October.
You mentioned the 2-year Treasury note and the incredible volatility. It's the most volatility that we've seen going back 40 years. You have to go back to the 1980s, basically, a little bit before that chart you see on your screen. Just as a big picture question, are you dusting off playbooks from bygone eras? I mean, I was alive during the era. I certainly wasn't trading, and I'm just wondering. Most people are fighting the last crisis. Most people's memories are kind of imprinted by their previous bear market experience. And given the fact that we don't have a lot of people who have been trading fixed income for the last 40 years, how is the industry responding to this?
Well, right now, I would say the industry has not responded and has not been proactive in anticipating the type of yield volatility that we're seeing this year. And that's a great analogy, dusting off the playbook from the 1980s per se, because what we're dealing with now, elevated yield volatility, because inflation is sticky at levels that are uncomfortable for consumers and the Fed. That means asset liability management at banks, at hedge funds, and insurance companies it all matters again. And so you're starting to see a replay of some of the stress we saw in the banking sector in the 80s, where asset liability management or duration gaps or interest rate mismanagement began to cause bank failures. I think we're seeing that again. And this is really more a consequence, I think, of the fact that people underestimated how sticky inflation was going to be and how quickly it was going to rise from stimulus that was put in place a year and a half, 2 years ago, and from the Fed being slow to raise rates. And once that inflation became embedded in the system, yields were going to spike, and yields were going to spike in a very volatile and very difficult to hedge way. And that's what we're seeing now. So I do think we have to pull back and bring out that playbook from the 80s. Unfortunately, some institutions did not do that in enough time.
All right. I appreciate your insights here. We got to leave it there. Thank you, Tom Mitsouris, Managing Director, Head of Fixed Income Research at Strategas, a Baird company. Coming up, we take a look at what just happened in the world of college basketball as both the men's and women's brackets get set for the Final Four this weekend. We break it down next.
Unrealized losses.
The unrealized losses.
We've been hearing the term unrealized losses a lot lately, but what does that mean? It's basically losses that are on paper. If you have an asset on your balance sheet as a company, an institution, it fluctuates in value, right? Because it's something that is pegged to the market. If that asset has gone down in price on paper, that is on your balance sheet, you have recognized a loss, an unrealized loss. That loss only becomes realized when you have to sell that asset if the price has gone down. One maybe easier way to think about it is to think about a real asset that might be on your personal balance sheet, like a house, for example. Let's say that you buy a house at $300,000 and you live in that house for a while, but then something happens in the housing market. The price of the house goes down a little bit, say to $250,000. That means it's an unrealized loss. You haven't sold the house, you still live in the house. If something happens and you're then forced to sell that house, you take a realized loss. That unrealized loss becomes realized because you've made the sale. But let's say you live in that house for a while longer and the price goes up. Well, then you don't have an unrealized loss anymore. You actually have a gain. So that's how we can think about these various issues. These losses don't become realized unless, like some recent companies in the news, you are forced to sell for whatever reason.
As March Madness enters its final weekend, the biggest takeaway hasn't exactly come from the men's bracket, but instead it's the hype and interest surrounding the women's side of the court. Yahoo Finance's Dave Briggs joins us to take a deeper dive in this week's installment of What Just Happened.
Yeah, some big money pouring into women's sports, and March Madness is at the center of all that. A full 50 years after Title IX was passed, the women's NCAA tournament is finally branded, like the men's, as March Madness, and in many measurable ways, it is ladies first in college hoops. We're talking tickets, TV, and social media. With San Diego State, Florida Atlantic, UConn, and Miami set to tip Saturday, at this moment, you can get tickets on StubHub for just over $70, while the average ticket price for this weekend's men's slate in Houston is $234 per SI tickets. That's a 92% drop from last year's blue blood-rich Final Four in New Orleans. Now, watching the women in person in Dallas will cost you nearly 5 times more than the men, more than $320 just to get in for the cheap seats on StubHub. And while both are in Texas, we should mention a key caveat here. The men's Final Four is played at a 70,000-seat NRG arena, while the women's play at 20,000-seat American Airlines Arena, but we have never before seen women's prices meet the men's, let alone exceed them. The women's game also attracting eyeballs, courtesy undefeated South Carolina and Iowa's Player of the Year, Caitlin Clark. Take, for example, Sunday's Iowa-Louisville regional final. It averaged 2.5 million viewers on ESPN. That's up a staggering 94% from last year, the largest audience ever for a women's tournament game outside of the Final Four, and even more than the most watched NBA game on ESPN all season. Yeah, that includes LeBron. Overall, the full women's tournament is averaging 660,000 viewers per game, up 42% from last year. On the men's side, not so much. Viewership was up early, but declined for all Elite 8 telecasts and Sweet 16 telecasts, and in some regards was the smallest audience since 2016. The same could even be said of women dominating the social media side. 7 players in the women's Final Four have more than 100,000 Instagram followers. 0 goose egg on the men's side. Why? A lot of factors here. For one, the men's Final Four features 4 teams with the 4 seed or higher. The women's seed are all top 3s, traditional powers and big stars. Also, a recent Ally Financial ad buy with Disney's ESPN may be the biggest deal yet. It's a multi-million-dollar deal that requires 90% of its investment be put into women's sports through expanded game highlights, branded content, and features across ESPN. So the media is finally helping. Women's professional sports sponsorships also grew 20% year over year in 2022, and more than 70% of sports executives believe women's sports revenue will grow by more than 15% over the next 3 to 5 years. That's according to PricewaterhouseCoopers. The National Women's Soccer League is also smashing record attendance ratings and ticket sales in what's shaping up to be truly the year women's sports truly began to bridge the gap. It is such an exciting time for the business of women's sports, Jared. They are really raising the bar at every level, and the Final Four is the quintessential example.
Some incredible stats there, Dave. I'm happy to see University of Miami, my home city there, at least getting a little seat there. In some
Tough one against UConn tomorrow
really
night,
tough.
but I will tell you, 9:30 tonight, Iowa, South Carolina, and the women's side might smash a TV record. I recommend you checking it out.
Will do. Thank you for that, Dave Briggs. And let's do a final check of the market right now. We're looking at some gains across the board. Dow up almost 250 points. The S&P 500 up about 85 bips. And the Nasdaq up over 1% here. And just checking in on the sector action on the Wi-Fi Interactive, it's looking like today, well, discretionary. Consumer discretionary is up the most, followed by communication services. That's all for now. I'm Jared Blickery.